This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 7 videos on protective stops. I'll begin by answering the obvious question, why use stops? And the answer is to protect yourself, mostly against yourself. A stop is useful in determining what your position size would be. Since the distance to your stop is a measure of your risk, that allows you to determine what your appropriate position size should be. Experienced traders always have protective stops in the market, not just in their heads. The purpose of a protective stop is to protect you and to protect you against many things. For example, there may be some surprise move that is much bigger against you than what you expected. There may be problems with your computer, with your internet connection, problems with your broker, problems with the exchange, all kinds of problems. And a stop does give you a high degree of protection, not absolute, but a very high degree of protection. Most importantly, a stop protects you against yourself. Traders often get emotional, especially when they're starting out, and they get hopeful. The market starts to go against them, and they don't want to take a loss. They keep the stop in their head, not in the market. The market goes through the stop in their head. They create a new fictitious stop, and the losses just keep growing as the trader never exits the losing trade. A stop means that you have to stop what you're doing. It's absolute. You get out and take the loss if it's a loss, but you get out. Don't question whether you should get out, whether you should move your stop. You put your stop where you put it because it made sense at the time you put the trade on. And if the market's going against you and you're now questioning whether your stop is in the correct place, you're probably getting emotional. And that's the very thing the stop is designed to prevent. It's designed to prevent you from allowing emotions to influence your decisions. So let your stop be hit if it's going to be hit and don't move it. Simply get out and wait for the next signal, knowing that losing is part of trading and the protective stop keeps you from losing too much. I think it's very important to understand that when you're managing a trade, it has nothing to do with where you entered the trade. It has only to do with what the market is currently doing at the moment. Every instant that there's a new tick on the chart, up or down, you have new information. And the management is based upon that new information, not based upon where you entered. It doesn't matter if you buy here or buy here, the stop is still there. For example, you could buy any one of these bull flags. Anytime you enter the market, there are usually several reasonable choices for stops. For example, if you buy here or here, you could put a stop here, arguing that you have a high 2, high 1, high 2. You do not want it to fall below the bottom of the high 2 bull flag. However, you have a strong reversal up, and this is a major higher low, a breakout to a new trading range high, not a breakout to a new high in the chart, but a strong breakout to a new trading range high. This is also an appropriate stop. If you buy here or here, this is a good place for a stop. This is also a good place for a stop. Let's say the market started to go up and you're at this point, or if you buy here, most traders would put their stop below this low. This is a major higher low. We have a strong breakout and a new high. Anyone who is holding along after this breakout takes place, he would have his stop here. It doesn't matter if you bought here or if you bought here. At this point, the stop for all of those traders probably is going to be right here. Again, it doesn't matter where you buy. Stop placement is determined by what the market is currently doing. And once you've had a strong breakout to a new high and a bullish channel, it's usually better to put your stop below that low. After this strong breakout and follow through, if the market falls below that low, then your premise of a bullish channel is probably no longer valid. The market then would either be in a trading range or possibly even in a bear trend. And therefore, since your premise is no longer valid, you get out. Again, it doesn't matter where you bought. If you bought up here, if you bought down here. Once you've seen this, and the market's now up here or anywhere in here, this is a good, reasonable location for your stop. We have a higher low major trend reversal, bear trend, bull breakout, higher low. You can also call it a head and shoulders bottom. We have a breakout, 50% pullback, a strong breakout, 2 legs down, 1, 2, second entry buy. You can call it a wedge, 3 pushes down, high 1, high 2, high 3. In any case, you have a very good looking buy signal bar and a higher low around a 50% pullback of this leg up. It's a reasonable buy. A lot of traders only think of stops as either being very wide or very tight. Some traders use other terms as well. For example, a trader buying above here, he could put a stop here, which is fairly tight. I would call that a price action stop. You're placing the stop based upon the current price action. You have a wedge bull flag, a high 2 at the second entry buy, a very strong bull signal bar. That's a reasonable place to put your stop based upon the current price action. So is this. This is a major higher low, a break to a new high above this high, and a strong rally. The market should not fall below this low if it's in a bull trend. If it falls below this low, then the market's not in a bull trend. It's either in a trading range or possibly a bear trend. Some traders like to use a money stop. For example, they might use a stop that is 10 ticks below their entry price or 10 pips below their entry price in a Forex trade, or maybe $100 below their entry, maybe 10 pips below or 10 ticks below the low of the signal bar. Some traders will look to scale in below. But anyway, the point is a money stop is based upon the number of ticks or pips or a dollar amount, rather than simply based upon the price action. Other traders just use very wide stops, and sometimes they'll be based upon the price action. For example, they might put a stop below the entire bull trend all the way down here, or they may use a stop that's several $100s below their entry price, or 30, 40, or 50 ticks, 30, 40, 50 pips below their entry price. And that is an example of a wide stop, which could be a money stop or a price action stop. You could put a stop based upon a measured move. We have a strong breakout. It should lead to a measured move up or down. If the market starts to reverse, some traders will want to give the market room in case the market forms a trading range instead of a bear trend. A logical location for the stop would be just at or below a measured move down, usually just below a measured move down. Once the market starts to go your way, you raise your stop in a bull trend, and that is called a trailing stop. If your stop was initially here, and we got a breakout here, a lot of traders will put their stop below the most recent major higher low, which is right here. That's called trailing the stop up. After every strong breakout to a new high, raise the stop to below the bottom of that major higher low. Lots of decent stop entry buys in a bull trend. Most experienced traders will get out below the bottom of the most recent major higher low. Is this a major higher low here? I don't know. The breakout's not all that strong. Here we have a decent bull bar, decent follow through, and then additional follow through. This is, I think, a fairly important price, as is this and as is this. These are all major higher lows here, here, and here. Most bulls, no matter where they bought, if they were still long up here and we had this surprise bar, they would have a stop below this bar and they would get out right here. Some instead would have a stop down here or here. Once they saw this big bear bar, they would conclude the bear bar was big enough so that we would get at least a second leg down, and they would get out on the close of that bar. We have a spike and a pullback and then a channel. A spike and pullback bull trend. A lot of traders expect the market to come down to the bottom of the channel, maybe a little bit below. They'll put a stop several ticks or several pips below the bottom of the pullback, expecting the market to come down there. Other traders will assume that spike pullback channel will lead to a trading range, and a trading range can trade down here, but it will have a rally afterwards. They'll instead use a wider stop below the bottom of the bull trend instead of just below the bottom of the channel, thinking that the market might fall below this low, but as long as it stays above this low, it probably will enter a trading range, and therefore they could exit higher. If they're long from any of these entries and they hold through a pullback here, betting on a bounce, they could get out with a smaller loss if they bought up here, or with a bigger profit if they had bought down here. Everyone is naturally very hopeful, very understanding, and very forgiving, and they assume that the market will behave consistent with those feelings. But that's not the way markets work. A beginner often thinks of a market as a person who does not realize that he is making a mistake. I think it's natural for a beginner to think of the market as a person. In every other aspect of life, you're interacting with people, and now you're interacting with the market. You tend to personalize the market and think of it as a person. And a beginner, when he sees something like this, thinks the person, the market, is making a mistake, but he does not realize what a terrible mistake he's making. People tend to be forgiving, and a beginner has a natural inclination to give the market a chance to fix its mistake, redeem itself, and become a good person again. Maybe he'll look at this as a bear trap, a failed bear breakout. He'll come up with all kinds of reasons to deny that this is real. It's still above the bottom of the channel. It's still above the bottom of the bull trend. Maybe a beginner who is not using a stop will give the market more time. Maybe the market will see it's making a mistake and it'll go back up. Now we have a second bar, and it has a bear body. That is follow through, and it increases the chances that this is real and that the market's going to go lower. Let's take a look at a beginner who bought right here, and now the market's down here with a big bear breakout well below his entry price, and we have a follow through bar as well, another bear body. The beginner does not want to exit a trade too early because he'll feel like a loser, and he knows that experienced traders are making money all day long. The beginner starts thinking about the personality traits of good traders: discipline, they're positive, they don't worry about losses. The beginner wants to think like a winner. All he's doing is trying to justify holding on to a losing position, a position that he really needs to exit. He doesn't want to look at this as a reversal with follow-through, and he doesn't want to believe that the market now favors the bears, the probability favors the bears. He just simply denies what's in front of him. We have a spike pullback channel, we have a huge bear breakout, and a follow-through bar. The odds are we're always in short, which means the probability is we're either going to go sideways or down, and the first rally, traders will sell it and will go down. So he bought here, he sees the bear breakout and the follow-through bar well below his entry price. He's still hoping that there's a chance that this will be a higher low and lead to trend resumption up, even though if he was objective looking at this, he'd say, no, we're going down, or at least we're going sideways. People want to be virtuous. Again, they want to personify the market. They want to think of the market as a person. And the beginner wants to allow the market to fix its bad behavior. The beginner wants to be forgiving because being forgiving is virtuous. And he wants to see himself as a good person. Again, these are just all the kinds of thoughts and feelings that beginners have to justify staying in a losing trade. They're all wrong. At any given instant, there's always a reason to be long and there's always a reason to be short. But sometimes one side has a terrible probability, a very low probability of success. The beginner who bought up here and now is sitting with a loss, he wants to pretend that he's being objective and that he's analyzing this just the way any professional trader would look at it. He comes up with all kinds of plausible reasons to justify his staying long. There's follow through, but it's only a doji body, and it's still a higher low above the bottom of the channel, above the bottom of the spike. Maybe if he holds on, he'll get a bounce that will allow him to get out with a smaller loss. Maybe it'll bounce back above his entry price, and he'll be able to get out break even. The beginner is going to come up with every possible thing that he can conceive of to avoid thinking about the real reason why he's holding long when the market's clearly bearish. Why do you think the beginner is holding long? He bought here and now the market has done this. Why is he holding long? There's one reason. He's afraid to take a loss, because if he takes a loss, he sees himself as a loser. And if he takes enough losses, his account will slowly disappear. He's afraid of the death of his dream of becoming a successful professional trader. That is the fundamental issue. And he's coming up with all kinds of reasons to avoid that thought, but that is his thought. He's afraid of death, the death of his dream. He's got to get over it. When you trade, you're going to lose. You're going to lose some of the time, and as you get better, you lose less often, and your losses become smaller. But even experienced traders are going to lose some of the time. And you can't dwell on the losses. You have to make the correct management decisions, and you have to rely on your stop. The beginner's still long. He sees a bear bar, a doji bar, a bear bar, a bull bar, and he's arguing, oh, consecutive sell climaxes was still a higher low. Maybe we'll get a 50% bounce and I can exit with a smaller loss. It's a mistake. It's all a justification. He's just simply denying what's in front of him, hoping that he will not be forced to take a loss. Maybe he can lower his stop down here, the next logical support area, the bottom of the bull trend, spike pullback channel. He's thinking calmly that, okay, I want to stay objective. I want to think about this the way the pros would think about it. And the pros certainly could manage their way out of this trade and avoid a loss. But that's not true. Pros take losses. When the market is going against them and their premise is no longer valid, we take our losses. You know, the pros know when they're wrong, and they just get out with a loss when they're wrong, and they don't worry about it. They just accept that nothing is 100% probable. Even the best things are only 60% probable. That means you're going to be wrong 40% of the time. That's part of the business. When you're wrong, you exit. Now we've had a breakout to a new low of the day, 4 consecutive bear bars here, consecutive sell climaxes. It's probably going to collapse into the end of the day. The beginner thinks, okay, I better just admit that I'm wrong and take my loss. He thinks he traded just like a pro. He gave the market room. This is just one of those situations that even an experienced trader would lose money. And he finally ends up taking his loss on the breakout to a new low. We're clearly in a strong bear trend. On the other hand, when I look at this, I'm thinking, big bear bar, probably at least a small second leg down. Another big bear bar, looks like probably a little bit lower, but now we have consecutive sell climaxes here, here, a 2-bar sell climax here, another sell climax here, and look at the follow through, a doji, a bull bar, a bull bar. This looks like a bear leg in what will become a trading range. So we'll probably bounce soon. Also, it's an expanding triangle, low, low, lower. Not a good shape, but still an expanding triangle. And it's also possibly a breakout below a developing trading range. Beginners looking at this as the end of the world, and you cannot just stay long anymore. He bought high, and the market's now very low. He just lost way too much money. But that's not what an objective, experienced trader is going to see. He's going to see a series of consecutive sell climaxes and a new low. This is probably a bear leg in what's going to become a trading range. And therefore, traders are expecting 10 bars, 2 legs up pretty soon, and they're starting to look to buy. And this is what we've got. The beginner exited his long down here on the break to a new low, and the experienced trader is looking at trading range price action, spike pullback channel, and probably a conversion into a trading range. And therefore, once the channel is going on and has had several legs down, it probably is going to go up. The opposite of this, spike pullback channel, after several pushes up, it's probably going to go down. No one left to sell at this price, and the weak bulls finally gave up. The bulls who bought all through here and did not get out when the market told them they were wrong, they finally give up. The strong bulls are never going to give up. They're going to hold and buy more as the market goes down. The bears, who did sell up here or through here, are expecting the market to bounce soon as well, and they're taking profits. So the strong bears are taking profits. They want to sell higher. No one left to sell at this price, and the result is a rally. Strong bears sold here, take profits, and do not want to sell again 1 or 2 bars later. They want to sell high, and therefore there's a buy vacuum. There's an absence of sellers at this price, and the market gets vacuumed up to prior pullbacks, this high, maybe even this high. Spike, channel down, consecutive sell climaxes. Probably we're going to get 10 bars, 2 legs sideways to up, maybe more. We have a micro double bottom here, a second entry buy here, a bull bar here. Should get at least to this high, probably to that high. This is a reasonable buy, so we should get at least to that high. Bulls will buy for a test of that high, test of this high. Where you put your stop determines how much money you're going to risk. The amount of money that you're willing to risk always determines how big a position you should take. You never want to risk more on any trade than you would on any other trade. Whenever you're looking to enter a trade, you first look where your stop has to be. That determines your risk. That also determines how big a position size you can take. You can therefore adjust the size of your position based upon where the appropriate stop would be. And you rely on your stop as long as your premise is valid. If the price action tells you that your original premise is wrong, get out, take the loss. Do not wait for your stop to be hit. On every trade, the total dollars that you're risking has to be no bigger than your comfort level. If you're thinking too much about the size of how much you can lose on a trade, you're not going to trade properly, you're not going to manage the trade properly, and you're going to lose money. You cannot be thinking about money, and therefore you have to trade small. You should always trade the I don't care size. Trade small enough so you really don't care very much if you lose. That way there, you can manage the trade properly and make objective decisions and do what those decisions tell you to do. For example, if you buy here a bull flag, bull breakout, a wedge bull flag, high 1, high 2, high 3, a good place for a stop is either right below the bottom of the wedge or below the bottom of the most recent bull breakout, a major high or low. The risk is from your entry price to the stop. That's your initial risk at least. And let's assume this is your average risk. Let's say this is as much as you're willing to risk on any trade. If this is your average position size and this is your average risk, you're buying in a strong bull trend. The probability is that the market's going to reward you with a profit that is at least as big as your risk. If you're buying here and this is a logical stop, 60% chance the market's going to go up that same distance before it gets to your stop. Because the probability is high, you can take a reward that's equal to 1 times your risk and still have a good trader's equation. The math makes sense. We're buying here, using the appropriate stop, and then taking partial or full profits at that same distance up. It's more likely that the market's going to go that distance up before it goes that distance down. And therefore, exiting with a reward equal to your risk makes sense. Let's say you're still long at this point. What do you see? You see a spike pullback channel. It's a nested wedge. Spike pullback channel, spike pullback channel. We have a nested wedge, different ways to draw the 3 pushes up. You have a series of buy climaxes. 1, 2, 3, 4, 5, 6. I have 4 written here. 1, 2, 3, but it's really 5, 6, 7, 8. A lot of consecutive buy climaxes. The odds are we're going to get a pullback pretty soon. The bears theoretically will sell below this bar, betting on at least 10 bars, 2 legs down. A lot of traders will not take the first sell. A lot of bulls, however, will exit on a second reversal down after a nested wedge top. Many of the bulls will get out here if they did not scalp out earlier. Aggressive bears would sell either here or here. Other bears would wait until they see the big bear breakout or follow through and then sell, expecting at least a measured move down. Again, some bears will see the big bear breakout, see the bear bar on the next bar, and then sell the close, expecting a measured move down. If you take that short, your stop at a minimum is above the top of the bear breakout, the bear reversal, the bear sell climax, whatever you want to call it, or above the top of the bear trend. However, look at the size of the risk. I said if this is your average risk for your average position size, now if you take this sell, the risk is twice your average. And that means if you take this sell, you have to reduce your position size because you want the total dollars at risk to be the same. If your stop is twice as far away, you have to trade a half of your normal position size, maybe even less. This stop location determines the size of the position of your short. Strong bear breakout and follow through, 60% probability you're going to get a measured move down based upon the distance to your stop. 60% chance if you sell here, the market is going to go down here, this distance, before it goes up here. Because it's a 60% probability of reaching a reward equal to your risk, you can take all of your position off or part of your position off at 1 times your initial risk. This is the distance. Here's the same distance, a reasonable location to take profits. And you can see a lot of traders did take profits here. Again, if you sold here and used the correct stop, your risk is twice normal. Your position size is half normal. But because your risk is twice normal, you need a profit that is twice normal as well to make the trader's equation positive. I talked about the reason why traders use stops. Protective stops are to protect you against anything unexpected. And if you're a beginner, they're very useful to protect you against yourself. The stop's location determines how much you have at risk, and that determines your position size. If the stop is twice as far away as you normally have it, you have to trade a position that is half of your normal size. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This was the first of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 7 videos on protective stops. I want to talk a little bit about what happens after a stop is hit. I also want to talk about the importance of using the correct stop. There are often several choices for a protective stop. One that is too small or too wide is usually a losing strategy. It's a trading range. It's a head and shoulders bottom. It's a high or low major trend reversal. Both are always part of a trading range. You can call it a triangle. You can call it a double top, a bull breakout above the double top, and therefore a failed breakout above a double top is a wedge. So if you want to call it a wedge, 3 pushes up, 1, 2, 3, you can. I would call it a triangle. Whenever the market's in a triangle, 50% chance you're going to get a successful breakout to the upside, 50% chance you'll get a successful breakout to the downside. Therefore, it's reasonable to sell here. We have a double top here, and now we have a small double top within the double top. The bears see it as a bear flag, a bear trend, and then a trading range or a triangle or a wedge, a decent sell signal bar. This is an appropriate sell right below the low of that bar, and you get filled here. A logical stop is above this small double top, which is also above the top of the triangle. This is what you got. A lot of traders would look at this and say, okay, that's a pretty strong bull breakout, and we have 3 pushes down. 1, 2, and then a bull bar, and then 3, another push down. and we have a pretty good buy signal bar after a decent buy signal bar here around a 50% pullback of this breakout. Therefore, this is a wedge bull flag, and the market's probably always in long. Instead of going down, we might be going up. Most bears would exit above the high of this bar, and many bulls would buy, betting that we're going to rally. The bears who did not exit here, the ones who relied on their stop, get out right here, just above this high, this double top. Bulls buy as well. They'll buy just above this double top, knowing that the bears will have stops there, the bears will give up. They'll buy the close of this bar. We have a bull breakout bar here, a follow-through bar. They'll buy above the high of this bar. They'll buy above the high of this pullback bar, a high 2, high 1, high 2. Now we have a micro double bottom, up, down, up, second entry buy, another buy. Bulls will buy for any reason in here, looking for a measured move up based upon the height of the trading range. At this point, we're around a measured move up based upon the height of the trading range. Here's the breakout, the pullback dipped a little bit below it, so it's a negative gap. And here's the measured move projection. It's also a wedge, and it's also a big double top with this top of this bear trend. Slightly higher high double top, but it's a double top. Some bears will take that sell. It's not yet high probability. We have too many bull bars, and you don't want to be selling below a bull bar. This might be a little bit early. It's an okay sell, but low probability. A bear selling here might put a stop here, betting that if it goes above here, it's breaking above a wedge, and therefore a 50% chance of a swing up. Other bears might think, okay, we're getting consecutive buy climaxes. If this is not the top will probably come pretty soon, so maybe you just use a very wide stop and stay short. The bears who did use the wide stop did not get stopped out, and they were able to hold short for the swing down. The bears who did sell here and got stopped out here could sell again either here, or wait for this, betting that all of those entries have a reasonable chance at making money, especially selling here or here. Again, the bear who sold here, if he got stopped out, he's going to look to sell again. A failed breakout above a wedge, a second entry short below that bear bar, or on a strong reversal down here. It's not a big problem getting stopped out. If your trade ultimately proves still valid, you can always sell again. For every trade, there are several choices for a stop, and usually 2 or more of the stop choices are reasonable, and therefore you could take either one. Make sure to always choose a reasonable stop. We have a huge bull breakout of a tight trading range. This bar is maybe 5 times bigger than the average bar, and therefore you cannot use an average size money stop. You have to allow for a deep pullback. If you buy this close, for example, or if you buy above the high of this bar, your stop is all the way down here. If you buy this close or above the high of this inside bar, you get filled right here. You have to use the correct stop. The most logical stop is below the bottom of the bull breakout. If the market falls below the low of this bull bar, then your premise of a bull trend reversal or a bull breakout is no longer valid. Therefore, it's a major low. We have a strong bull breakout, 4 consecutive bull bars closing at their highs and a new high. At any point from here onward, this is a reasonable stop. You can trail your stop from here to here. So you move it from here to here. That's called trailing your stop or raising your stop. You want to keep your stop below the bottom of the most recent major high or low, because as long as the market continues to have strong breakouts to new highs, it's in a bull trend. If it falls below one of those major higher lows, then the premise of a bull trend is no longer valid. The market is then either in a trading range or a bear trend. Another strong breakout to a new high. At this point, anywhere up in here, the stop now is below the bottom of the most recent major high or low, bottom of this strong bull breakout. Another strong bull breakout, 3 consecutive bull bars closing near their highs. A bull bar breaking above that high, and then a good follow-through bar. Chances are we'll get at least a small second leg up, maybe here, maybe pull back here. You can buy the close, you can buy above the high of this bar, above the high of that bar. You can even buy the low of this bar, betting the reversal down will fail. You can buy a bear close, especially a second bear close, thinking that the bears need 3 or more bear closes to reverse this bull breakout. And then you could buy here, a double bottom. Not the same level, but it's still a double bottom. Another reasonable buy above a decent bull bar. You can buy for any reason. The stop for all of those trades, most appropriately, is here or here. Spike, pullback, second push, pullback, third push. This is a potential wedge top, but even here, the market's still always in long. Chances are a reversal will be minor and result in a trading range. It may come all the way down here to the bottom of the channel, breakout, pullback channel, a wedge channel, but it's still always in long. What do you do if you bought down here and now the market is doing this? We have a bear bar and a wedge top, decent reversal here and here, bad follow through after a bull bar here, and again here. We're probably transitioning into a trading range. The premise of a bull trend is no longer valid. It's reasonable to exit with a stop just below the low of this bar. You get filled right there. Alternatively, you could still rely on your stop at the bottom of the channel, hoping that whatever pullback we get becomes a bull flag and the bull trend resumes. One big problem for beginners is they tend to only focus on risk and they ignore probability. And the result is they use stops that are either too tight or too wide, usually too tight. For example, let's say a beginner looks at this price action and he does not want to use a stop that's too tight because he knows he'll lose. He does not want to use a stop that's too wide because he knows he doesn't want to risk that much. And he ends up picking something in the middle. So it's a middle of the road type stop. I call it a dead skunk stop. And in general, it's the worst choice. If the trader did not exit on the reversal down from the wedge, and he was still planning on using the stop down here, he would be concerned by the number of bear bars down, the size of this pullback, and he'd be afraid that maybe the market's converting into a bear trend. Beginners start to panic and worry, and they see, okay, we have 3 bull bars here. This is a major higher low. I can put my stop just below this low. No, it's not a major higher low. It's a reversal up. But is it a very strong reversal up? Look at here and here and here. Those are strong reversals. Is this a strong reversal up? Is it a reversal to a new high? No, this is a minor higher low, and putting a stop below a minor higher low is a terrible thing to do, because very often the market will have a first leg down, a pullback, and then a second leg down slightly below the first. The market very often falls below minor higher lows, and then the bull trend resumes. Placing a stop just below the low of that bar, that is a skunk stop, and it's a sure way to lose money. After the beginner failed to get out here, he cannot take the stress. After 5 bars, 10 bars, 15 bars, he can't take the pressure, and he just has to get out, and he'll use any excuse to get out. He'll convince himself that this is a major resumption of the trend up and not simply a leg in a developing trading range, and he'll get out below the bottom, and he ends up selling at the bottom of a trading range. It's never good to sell low in a trading range. You want to sell high, like up here, when you think the channel might be converting into a trading range. Experienced traders, they'll say, okay, it was a spike in channel bull trend, it's transitioning to a trading range. In a trading range, I want to buy low, especially below the low of a prior low. The beginner is selling out of his longs here. The experienced trader is buying at this low, betting that it's a breakout in a trading range and it will fail and the market will reverse up and not the start of a bear trend. Beginners do need to keep their risks small. and therefore they should only take trades where they can use an appropriate stop. For example, a stop beyond the signal bar. If a beginner buys above this bar, betting on a double bottom, slightly higher low, it's reasonable to put his stop just below the low of that bar. An experienced trader can often use a wider stop. However, if the market requires him to use a wide stop, he'll trade small. A lot of times when he's using a wide stop, he'll trade small with the intention of scaling in if it makes sense. Therefore, an experienced trader has many more opportunities to make money. Scaling in increases your probability. It's a trade-off, higher probability, greater risk, but an experienced trader can do that. For example, an experienced trader might buy here, betting that the market's either in a trading range and he's buying low, or it's a bull flag and will get a resumption up. But if he buys here, the appropriate stop is either here, we have a strong breakout to a new high, or all the way down here, spike pullback channel, the bottom of the wedge channel. If he's buying here, a lot of traders will buy here and put the stop down here and buy more if the market falls lower. For example, he buys here, he may place a limit order to buy more if it goes to a new low, betting that the market's at the bottom of a trading range and not in the early stages of a bear trend. He uses his wide stop and he scales in. You can call this a trading range. We don't know what took place here, but let's say it was a bear trend, so you want to call it a slightly lower low, major trend reversal, or a double bottom, major trend reversal, or just a failed breakout below a trading range. That doesn't matter. We have a strong breakout closing above the high of the past 30 bars, and a follow-through bar, a follow-through bull bar closing above its midpoint. Chances are the market's going at least a little higher. Bulls can buy for any reason. They can buy the close. They can buy below the bear bar, betting the failed breakout will not reverse the trend and that there'll be buyers below that bar for at least a small second leg up. You can buy above a high 1 bull flag, a pullback from the breakout. For whatever reason you buy, the stop is obvious. It's below the bottom of the bull breakout. Strong bull breakout, 60% probability the market's going to rally for a measured move up. 60% chance it's going to rally to here, which is the distance from the entry price to the stop. The stop is actually just below the bottom of the bull breakout. But in any case, 60% chance this low to your entry price, you'll get a measured move up to here before you get stopped out below. Deep reversal increases the chances that instead of a bull trend, the market's now in a trading range. But in any case, chances are the market will come back to the top of the range before it hits this stop. The market's probably still always in long, despite 4 consecutive bear bars, because it's still a pullback from this strong bull breakout. Reasonable to stay long and rely on your stop. Some traders will exit on the big breakout or on the close of the follow-through bar, and then look to buy on a reversal up. And this is what we got in this particular case. A deep pullback after a strong bull breakout, and then a very strong bull trend. Is it forming a triangle or a lower high for a bear trend? Sure. However, I think we're still always in long. We're still above the bottom of a very strong breakout. The traders who did exit over here on the close of the follow-through bear bar are looking to buy again. They could buy again above a bull bar here, or above a bull bar here, or above this inside bar here. If this was a bear trend, this is a higher low major trend reversal. If this was simply a trading range, this is a breakout and a pullback. Another reason to buy, looking for a reversal up. I talked about what happens after a stop is hit. In general, there's a 50% chance that the breakout will lead to a swing, and there's a 50% chance that the breakout will fail and reverse. I also talked about how it's important to use a logical stop, one that is not too small nor too big. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 7 videos on protective stops. Most traders begin using price action stops, stops based upon the bars on the chart and the patterns on the chart. I want to talk a little bit about how a bull trend needs higher lows. They're more important than higher highs because bulls put their stops below the most recent major higher low. If the market falls below that major higher low, traders assume the bull trend has ended and the market has entered either a trading range or a bear trend. When you're in a trade and you have a stop and the market goes your way and it makes a strong breakout, traders will often raise their stop to below the most recent higher low. That is called trailing your stop. And the same is true in a bear trend as well. And I'm going to talk a little bit about stops in a bear trend. We have a bear trend, a rally. I don't have the trend line drawn, but it's a rally that broke above the bear trend line. And then we have a pullback to a higher low. And now we have a strong breakout, 5 consecutive bull bars, 2 with good sized bodies closing on their highs. This is a higher low major trend reversal. Since there is a left shoulder over here, it's also a head and shoulders bottom. The market is always in long and probably will go higher. Whenever you look at a signal bar that is possibly the start of a strong leg up, traders will put the stop right below the signal bar low. For example, if they buy above this bar, they'll put the stop below its low, especially once we get a strong bull breakout. On the other hand, sometimes you'll buy above a signal bar and you're not sure that it's the end of the pullback and the pullback may continue to grow. In that case, you put your stop below the most recent major higher low. For example, we have a buy signal bar here for a high 2 bull flag, 2 legs down, 1 pullback 2, but the body is small compared to these 2 big bear bars. These 2 big bear bars are strong enough so that the market might have a second leg down, 1 pullback 2. If you buy above the high of this bar, you get long here. In general, you should not put your stop here. There's too much risk that the market is going to go below that low, as it did here, yet still remain always in long. It'll still fail to get below the bottom of the most recent major higher low. This is a major higher low because it's a strong rally and it went to a new high. If the market falls below this low, traders will question the premise that the market is now in a bull trend. They'll assume that it is either in a trading range or possibly even a bear trend. High 2 bull flag, here's the buy signal bar. It's okay to buy above its high, get long here. Higher probability to buy above this bar. If you take this buy above this buy signal bar, I would put the stop here. You could put your stop here and then buy again on the reversal up from here. However, you end up losing your entry price to your stop price. It's better to simply rely on the wider stop and trust that you're correct, that this is a bull trend and this is a bull flag, but it might pull back a little bit more. Traders can buy for any reason. We're always in long. They could buy on a stop just above this high and get filled right here. We have a breakout bar here, big tail. Okay to buy the bull close of this bar. A bull close is good follow through. You could also buy above the high of this bar. You could buy a high 2 buy, high 1, high 2, and now we have a second entry buy for that high 2 bull flag here. We have another breakout and follow through bar and a pullback, another bull flag. You can buy above the high of this bull bar. It doesn't matter where you bought. All of these trades have the same stop, below the most recent major higher low. A strong breakout to a new high. This is a major higher low. If the market falls below it, the premise of a bull trend is no longer valid. Therefore, this is a reasonable place to place your stop if you're betting that the market's going to go higher. Whenever you're buying later in a bull trend after a strong breakout, the stop is further away compared to buying here or here, but the probability of higher prices is higher as well once you've had a strong breakout like this with good follow through. A bull trend needs higher lows and higher highs. It especially needs major higher lows. If the market's no longer making higher lows, then the premise of a bull trend is no longer valid. It's probably either a trading range or possibly even a bear trend. Bulls like to put their stops below the bottom of the most recent strong bull leg. This is a major higher low. We've had 8 bars up without a bear body. This is an important higher low. It's a buy the close bull trend. You could buy closes here, any of these closes. Let's say you bought here. You could buy for any reason. You could buy at the market, you could buy a close, you could buy above this bar, you can buy at the low of this bar betting the reversal down will fail. It doesn't matter. Anyone buying for any reason through here has the same stop, below the bottom of the major higher low. It doesn't matter where you bought, anywhere after this close, all through here, traders use the same stop, below the bottom of the most recent major higher low. I mentioned a couple times here that bulls need major higher lows. If you buy here, your stop is here. If the market falls below this major higher low, it's probably no longer in a bull trend. You could get out below this bear bar and then look to buy again above a bull bar. It did not get above this bull bar, but it did get above this bull bar, so you could buy again right there. And once there's a strong rally, especially one that goes to a new high, but not always, sometimes the strong rally does not quite reach the major high, traders will raise their stop from here to below this low because they'll consider this a major higher low. If the bull trend is still intact, it should not fall below the low of this strong bull breakout. That's trailing the stop from the original location to a new location. This might be a higher low major trend reversal. We don't see the bars to the left, but let's assume that it was a bear trend, this is a rally, and this is a higher low major trend reversal. Doesn't matter. It's still a bull trend whether or not there was a bear trend before it. It could have simply been a breakout of a trading range. We have 3 pushes up, 1, pullback, 2, pullback, 3, pullback, a new high, this is slightly above that, and we have a bear reversal bar, a bear inside bar. This is possibly a failed breakout. Strong enough breakout, traders will buy the close. They'll buy for any reason. They'll buy at the market, they'll buy on a stop above the top of this leg up. Because it's a third push up and a possible failed breakout and a strong bear bar closing on its low, this is a possible wedge top, and it could be the end of the rally. You have several choices here. You can exit below the low of this bear bar and then look to buy again if there's a bull bar and a reversal back up. Other bulls will rely on their stop below the bottom of the most recent higher low, betting that any pullback, even if it's deep, will convert the bull trend into a trading range instead of a bear trend. In other words, the market will stay above this low and test back up to this high. And the final choice is you could simply rely on your earlier stop. This is an especially strong rally and the start of a bull trend. And sometimes the market may have an ABC pullback, A, B, C, where C falls slightly below this low, but not below the bottom of the bull trend. All 3 choices are reasonable. And look at what happened here. Let's say you did exit below the low of this bear bar. You're looking to buy again above a bull bar on a reversal up, but this low is slightly below that low. For the bulls who tighten their stop from here to below the low of this bull leg, they get stopped out here. And that's okay. They can buy again on the reversal up. Some bears would take that short. It's a wedge top and a strong bear bar closing on its low. I think it's a good location to exit the longs. Typically in a situation like this, a wedge top with a good sell signal bar, I would exit below that bear bar, exit my longs. Some bears would short. With 3 bull bars closing in their highs, I typically would not take that short. I think a minor reversal in a trading range is more likely than a bear trend. Some bears do take that short, and it is a reasonable short. We have a strong bear reversal, 2 big bear bars reversing these 3 bull bars, big up, big down, big confusion. Usually a trading range is likely, but a wedge, 1, 2, 3, typically has 2 legs sideways to down. 1, pull back 2. It's still above the bottom of the bull trend, even though it fell below this low. It could simply be a 2-legged pullback, 1, pullback 2, where the pullback went above the top of the bull trend. It could be a double bottom bull flag, which is a large high 2. Leg 1, high 1, and then pullback, and then possibly leg 2. Still above the bottom of the bull trend, still a possible higher low. Compared to this, it's obviously below this. It's still a possible broad bull channel, where you have a rally and a deep complex pullback, sometimes even going always in short, but then a new high, and then another higher low, and a new high. For the bears, they see a wedge. 1, 2, 3 pushes up and a reversal. They're expecting at least a second leg sideways to down after a reversal this strong. Whenever I see big up, big down, and a buy signal bar like this, I often do not take that buy. Because big up, big down creates big confusion in a trading range, I usually wait for a second entry buy. You can see the market went above the high of this bar and then immediately went below it again. This is a second entry buy. It's still above the bottom of the strong bull trend. Buying above this bar is a higher probability buy than buying above this bar. I would use the same stop for both. Had I bought above here and got filled here, or bought above here and got filled here, my stop is still here. We had a reasonable buy here, pretty strong rally. I think it's reasonable to be long here. The market never gave the bulls a chance to get out. Immediately there was a disappointment bar, and we did not get any bounce up to this close. A trader buying this close and managing his trade properly using a correct wide stop and buying again above a bull bar, either above this bar or above this bar, or maybe above this bar, usually is able to avoid a loss. This reversal down is still above the bottom of the bull leg. I think a trading range is more likely than a bear trend. And if it's a trading range, it goes down, but it also goes back up. If you take a reasonable buy, buying a strong bull close and a bull trend, usually the market will let you out without a loss if you manage your trade appropriately. Some bulls will rely on the wide stop, the bottom of the initial very strong rally, and they'll look to add on above a bull bar, either here or above this doji or above this bull bar, expecting a trading range instead of a bear trend. The bulls who did exit below this bear bar know that it was reasonable to buy here, and therefore it's reasonable to buy more either here or here. The bulls who exited below this bear bar will buy here or above here, expecting the market to get back up here. And therefore it's reasonable to buy above a bull bar here or here. And you can see that if a bull bought here and used this stop, he would have made money. If a bull exited below this bar and bought more either here or here and used this stop, he would make money. If a bull exited here and he bought here for a test of this close, he would make money. He could also hold for a swing up. We have a double bottom. This is slightly below that. If you want, you can call it a lower low, major trend reversal. Bear trend, a lot of good bull bars, good buying pressure. An attempt to resume the bear trend, but immediately reversing up with a pretty decent bull bar. Good sized body closing above its midpoint. It's reasonable to buy on a stop above the high of this bull bar, and you get filled right here. It's a strong buy signal bar on the reversal up. It's appropriate and reasonable to put your protective stop just below the low of this bull bar. That is a price action stop. You're putting a stop based upon the price action right below the bottom of a buy signal bar where the context is good for a possible swing up. Strong breakout and a follow-through bar and another follow-through bar. Chances are there'll be at least a small second leg up. It might be this, it might be this, it could be many legs up, and we could go for a swing. We're rallying, we're pulling back, and then we have a bull bar here. Some bulls would buy above the high of this bar, a failed low 2, low 1, low 2. Other bulls prefer to buy above bull bars, and they'll buy above this bull bar and get filled here. It doesn't matter if you bought here or here. Look to the left. Where is the most recent major higher low? Is this a major higher low? No, it's minor. We could easily continue down more. Is this a major higher low? No, it did not have a strong breakout to a new high. This is the most recent higher low. It doesn't matter whether you bought here or here. The stop for both entries is still here, below the bottom of the most recent bull leg. Once you've had the breakout, 4 consecutive bull bars to a new significant high, above the top of the most recent major lower high in this case, traders will raise their stop. They'll trail their stop from here to here. So once the market is up here, it does not matter whether you bought here, or for any reason. Once the market is here, traders have a protective stop here. This is now the most recent major lower high. You could argue that it's still fairly minor and that you could rely on a stop down here, but most of the time, when you have a strong breakout to a new high with follow-through, the market will not come down to this low. So it's reasonable to put your stop just below that low. Another high 2 bull flag, 2 legs down, 1 pullback 2. Good looking buy signal bar. It's appropriate to buy on a stop above this high. And it's a good enough buy signal bar with bull bar here, bull bar here. It's a breakout test of the breakout point here, a test of this gap, a gap between this low and that high, this low and that high, this low and that high. Once you get filled on a long above here, it's reasonable to use a price action stop, a stop right below the bottom of this strong bull reversal bar. If the bull trend is valid and if the market is going higher, once you go above this bull bar, it typically would not go below its low, and therefore it's reasonable to put your stop here. And again, it doesn't matter if you bought here or anywhere down here. Once it goes above this bull bar, most traders would tighten their stop to just below the bottom of that bull bar. That is a price action stop. A small double bottom, a high 2 bull flag, a fairly tight trading range. If you take this buy above this bar, I think your stop is still here. But once this bar closes, you have a new breakout to a new high. It looks like we might be entering a trading range. I think once this bar closes, you do not want the market to come back below the low of this bar. Otherwise, the market might be in a trading range instead of a bull trend. It's reasonable to use a tighter stop. We're getting trading range price action here. The market might be evolving from a bull trend into a trading range. And ultimately, it did. It just had further to go before the reversal down. If you buy above this bar, your stop is here. By the time the bar closes, I would trail the stop here. If the market's going to evolve into a trading range, you don't want to be using too wide of a stop. You want to begin to trade it like a trading range. Buy low, sell high, and scalp. 2 legs down, a bear bar, bull bar, so first leg down, and then 2 bear bars, second leg down, reversal up, good looking bull bar. You can buy above its high. I would put the stop here just in case we get a wedge, 3 legs down, 1 pullback, 2 pullback, 3. But once you break to a new high, traders will raise their stop maybe to here. Another high 2 bull flag, high 1 pullback, high 2, stop either here or here. I would put the stop here. We're getting a lot of small bars, prominent tails. Chances are the bull trend will end soon and evolve either into a trading range or a bear trend. Weak breakout. We have a bull bar and a follow-through bar, but a tail and the bar is not big. We have a doji bar here. We have a bull bar here, a breakout, and follow-through. The breakout bar is not big. We have a pair of dojis. It looks like from here on, we're starting to get a lot of trading range price action. Traders will, instead of waiting for stops to be hit, assume that the market is in a trading range. Trading range, buy low, sell high. And sell high also means sell out of longs high on a reversal down. Traders will switch from using price action stops at the bottom of the most recent bear leg to selling a reversal down from a new high. A new high, traders will exit just in case it becomes a trading range. They buy here, we have a new high above here, and we're reversing down. The bulls will sell just in case it's the start of a trading range or even a bear trend. You can call it a wedge, 3 pushes up, here, here, and here. It's actually 4 or 5 pushes up. 1, 2, 3, 4, 5. You can even count this as a push up as well. In any case, we're getting a lot of pushes up, and here we have a gap that stayed open, this low and that high. And then here we have a gap that either stayed open or maybe there's a little bit of an overlap. So bears selling above this high did not make money. Bears selling at this high made money. Bears selling at this high might have made money. If they sell this high, sell a little bit more higher, they might have scalped. We're getting overlap, stairs, pullbacks of falling below breakout points. Breakout, a pullback below the breakout point. The market's starting to transition into a trading range, and therefore, instead of exiting on stops below the bottom of the most recent bull breakout, it's better to exit on a reversal down from a new high. The price action stop here is below this bar, not all the way down here. Bulls will exit. Aggressive bears might start selling using a very wide stop. I think it's still a fairly tight bull channel, and any reversal is probably going to be minor, followed by a trading range or a resumption of the bull trend. However, once you get 3 or 4 bear bars, especially a pair of big bear bars closing on the lows, the market has probably converted either into a trading range or a bear trend. And after 3 or 4 bear bars, 2 of them closing on their lows like this, traders will start selling this close and putting a stop up here, bidding on at least 2 legs down. I mentioned trailing stops. I'm going to talk a little bit more about it now. We have a double bottom, slightly lower low, and we have a breakout and a follow through. Traders will start buying closes here or here. After each breakout to a new high, if the breakout is strong, traders begin to raise stop, to trail their stops, to protect their profits, reduce their risk. Traders usually like to raise their stops to below the most recent major higher low. If the breakout is strong, the prior higher low can be major. For example, if you're buying here, your initial stop is down here. Maybe you'll put your stop here because we have a pair of breakout bars. In general, you're looking for a reasonable stop. Some traders will put a tight stop here. Other traders will use a wide stop there. Both are reasonable. If you use a tighter stop, you're going to lose more often, but you'll lose less per loss. If you use a wider stop, you're going to lose less often, and you'll lose more every time you lose. But after 100 trades, it doesn't matter if you use tighter stops or wider stops. Your net profit and your total losses will be about the same. The key is doing something that is reasonable. If you use a stop that is far too tight, you're going to lose money. It's a losing strategy. If you use a stop that is far too wide, you're going to lose money. Can you put a stop below the low of this breakout bar, arguing that if it falls below this low, the breakout will have failed? That's a fairly tight stop. Probably better to put a stop below here, the bottom of the bull leg, or even down here. Both are reasonable. Some traders will buy here and say, well, it shouldn't fall much below a 50% pullback. I'll put my stop right below the midpoint of the rally, the bottom of the rally, the top of the rally, or the entry price, and this is just below the midpoint. Other traders will put a stop here below the bottom of the bull trend. This is really a major higher low. This is minor. We could pull back more and still be in a bull trend. This is minor as well. We have a reasonably good breakout to a new high. Is this major? Typically, if the breakout is good and the trend will continue, it should not fall below here. So it's reasonable to put a stop here as well. But sometimes when you have a bull trend, you get a very deep pullback. Therefore, it's better to use a wider stop. You lose more when you're wrong, but you have a higher probability of making money. All of these stops are reasonable choices. And if you take 100 trades and use any of these 4 types of stops, the total profit after 100 trades will be about the same. I want to talk a little bit about stops in a bear trend. I was using a bull trend to illustrate examples of how to use stops. Let's say there was a bull trend here and we don't see it, and then we got a small higher low major trend reversal here, and you sell below that bear bar and you get filled. This might be a little bit below that bar, so you either get filled here or here. You could put your stop right above that high. In general, I would use a wider stop, and it's reasonable to put your stop above the top of that bear reversal bar. That's a price action stop. In general, if you have a small signal bar and you put a stop above its high, it's a low probability bet. Whenever you are risking very little, the probability of success is much less. Chances are, if it goes above this bear bar, it's probably not going to go much further. Some traders would prefer to use a wider stop, maybe up here, maybe a measured move up based upon the height of these bull bars. But let's say, for example, you put your stop above the top of this sell signal bar and you sold below its low and you got filled here. Other traders will wait for a bear breakout and then a pullback and sell below its low. Here we have a double top. We're up and down, up, maybe down. Traders will sell below here. It's a low 2 bear flag after a bear breakout, a reasonable swing trade. You can sell here or you can sell here. If you do, your stop is still up here at the top of the bear trend or possibly above the top of the strong bear breakout. After every strong breakout like this, especially one to a new low, a lot of traders will put their stop right above the top of that big bear bar. If it's very close to the top of the bear trend, I typically keep my stop at the top of the bear trend because sometimes it'll go above the top of the bear bar, but not above the top of the bear trend. Strong breakout to a new low. If this is a bear trend and not simply a trading range, the market should not get above the top of this bear swing. This is now a major lower high, and most bears would put their stops above the high of this bar right here. Every strong breakout to a new low means the top of the bear leg is a major lower high. As long as the market is making major lower highs, it's still in a bear trend. If it goes above the top of one of those major lower highs, your premise of a bear trend is no longer valid. The market is no longer in a bear trend. It's either in a trading range or in a bull trend. And therefore, if you took a trade based upon the idea that the market was in a bear trend and the market is showing you it's not in a bear trend, you get out. You get out when your stop is hit. 3 big bear bars, 6 or 7 bars down, a breakout to a new low. If this is a tight channel, bear trend, the market should not get back above this high. It's reasonable to put your stop above this high after you've seen this breakout and this follow through. 3 new bear bars. Once the market is down here, traders will put their stop above the top of this bear leg. This is a major lower high. It doesn't matter if you sold up here, or for any reason. If you sold this close, the stop now is above the top of this strong bear breakout. Another strong breakout to a new low. Once the market is here or here, no matter where you sold, your stop is now here above the top of that bear leg. The market's in a very tight bear channel, and we have a bear breakout here, another one here, another breakout here, another breakout here. And what do you notice about this bear breakout? It's the biggest bear breakout occurring 20 or more bars in a bear trend, and it's breaking below the bottom of a bear channel. 75% chance if you break below the bottom of the bear channel, you're going to reverse up. Whenever you see the strongest bear breakout, 20 or more bars late in a bear trend, that breakout is going to be an exhaustion gap. Right now, the gap is between this high and this low or that low. 75% chance we're going to get back above this low. This is probably an exhaustive end of the move, not an acceleration of the move into a stronger bear trend. Because once you see this exceptional bear breakout late in a bear trend below the bottom of the bear channel, and you know the odds are the market's going to get above the top of the bear breakout, you don't put your stop here anymore. You exit on a reversal up, especially above a bull bar. We have a bull bar here. It's okay to exit your short above the high of that bull bar. Other traders will wait to see if we get 3 consecutive bull bars, especially 1 or 2 having strong bull closes, and then they'll exit on that bar. And the bulls know the situation as well, and they'll buy. They'll buy above this bull bar or above this bull bar, or on the close of the third bull bar, betting that the market is going to get to the top of the sell climax before it gets to a new low. Strong bear breakout, traders will sell closes. They'll sell that close. Let's say you sold the worst close right here in this breakout. That's okay. It's okay as long as you use the appropriate stop. After every new low, traders look to trail their stop, tighten their stop to reduce their risk. You could still use a stop way up here, but if the trend is truly going to continue, it should not get above the top of the most recent strong bear breakout. It makes more sense to tighten your stop to above this lower high. If the stop is too far, it's not too far here, but if it is too far, a lot of traders will find other reasons to exit before the market hits that distant stop. For example, they might put a stop just above a 50% pullback. You often hear traders talk about using a break-even stop. There's no mathematical basis for a break-even stop. In general, it's not a good stop. Sometimes it makes sense to use because you don't know what to do and the market's moving fast and you don't want to risk giving back any profit. So emotionally, it's often a good decision, and therefore sometimes it is a good decision, but there's no mathematical basis to a break-even stop. If you're being totally objective, you're never going to use a break-even stop. Again, it doesn't matter what stop you use as long as it's reasonable. Tighter stops lose less every time you lose, but you're going to lose more often. Wider stops have a smaller probability of being hit. You have a higher probability of making money if you use a wide stop. When the stop does get hit, your losses will be bigger. After 100 trades, if you like tight stops, you'll lose about the same and win about the same as a trader who likes wide stops. As long as both choices are reasonable, it does not matter which you take. For example, it's reasonable to put a stop above the top of this bear breakout. It's also reasonable to put the stop above the top of the entire bear leg, above this lower high. Some traders will look at the entire bear trend and say, oh, I don't know, it could easily get above this bar, form a higher high double top, and resume down. Maybe I want to put my stop above the top of the entire bear trend. If that's too far, maybe instead I'll simply put my stop above a 50% pullback, which is here. Top of the bear trend, bottom of the bear trend, 50% pullback here. Maybe I'll put my stop a little bit above the midpoint. And then some traders will keep their stop above the top of the entire bear trend. A tight channel like this is going to be a breakout on a higher time frame, and keeping the stop here is simply putting your stop above the top of the bear breakout. Again, these are all reasonable stops, and therefore any of them is good. If you sell this close and you put a stop above this bull bar, that's probably not reasonable. Chances are you're going to get a pullback, but the bear trend will continue down. You do not want to use a stop that's too tight. You don't want to use a stop that's too wide. Both of them result in losing strategies. I began by talking about a price action stop, a stop based upon the patterns that you see on the chart. I made the point that bull trends need higher lows, major higher lows. If the market falls below a major higher low, it's no longer a bull trend. It's either a trading range or a bear trend. If you are in a trade and the market moves in your direction and you have a new major higher low, you can raise your stop to below that major higher low. Moving your stop is called trailing your stop. I then talked about stops in a bear trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This was the third of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 7 videos on protective stops. For a trend to continue, it has to respect prior pullbacks. It needs to continue to make trending higher highs and higher lows. At some point, your premise will change. For example, if you're holding a position and you believe you're in a trend, but the market price action tells you that is no longer likely, then you have to change how you're trading the market. We clearly have a bull trend with higher lows and higher highs. And whenever the market's in a trend, you can always draw lines that contain the price action, a bull channel. A trader who's buying or is long is holding his position on the theory that this is a bull trend. As long as the market is continuing to make major higher lows, then it's continuing to be in a bull trend. For example, this is a minor higher low. The rally that followed it was only very brief, and the market fell below it. But it did not fall below this low, a strong breakout to a new high. This is a much more important higher low. This is minor, and if the market falls below it, a trader is not going to change his opinion that the market's in a bull trend. He'll still believe it's a bull trend, and he'll believe that the pullback is simply more complex. After every strong breakout, especially a strong breakout to a new high, traders will raise their stop to below the most recent higher low. That is a major higher low. If the market never falls below a major higher low, then the premise that the market's in a bull trend is no longer correct. The market has then evolved into either a trading range or possibly even a bear trend. Here we had a strong breakout to a new high. We have a major higher low. Yet we had a strong reversal down that broke below this higher low. Once the market does that, do you still believe the market's in a bull trend? It might be in a much broader, flatter bull channel, but most traders would look at this and say the bull channel now has evolved into a trading range, possibly even a bear trend. It broke below the channel, the trend line. Bears will start looking for lower highs to sell, hoping for a series of lower highs and a bear trend. For example, a lower high major trend reversal. Not high probability after 3 bull bars, 2 of them being big. More likely, big down, big up, big confusion, and sideways. Is this a minor or a major higher low? I would call it a major higher low. We have 3 bull bars closing near their highs, and we have a new high. However, I also think that we've had several pushes up. We're getting near the top of the channel. If we do get a reversal down, the market might start to form a trading range. In any case, if the market falls below this low, probably the market is going to go sideways. Big up, big down, big confusion. This might be minor in the eyes of some traders. The bars are not all that big. And as I said, this two-legged pullback is still above this higher low and above this low. The bulls still might be in a very broad bull channel. We had a strong pullback after an initial very strong breakout, and we've trended up since then. This is a more important higher low than this. This is, I think, major enough so that bull swing traders will conclude the market's probably in a trading range. But some traders will look at it as minor, and maybe we're just pulling back to a large wedge bull flag, and we'll get trend resumption up. This, I think most traders believe, is a strong attempt by the bears to reverse the trend, and the bulls reversed up strongly instead. This is a very important higher low. Most traders would view this as very important. Some would view this as important. Others would view it as minor. We have a spike pullback channel, 3 pushes up, 1, 2, 3. We also have maybe a 30 or 40 bar very tight bull channel coming from this low. If the market falls below this low, the final bulls will give up. And that's what took place with these 2 big bull bars. The bulls believed it should not have fallen below this low if the premise of a bull trend or even a trading range was intact, and by falling below that low, the final bulls gave up. Some gave up below this low over here, and then others gave up here, but they bought this low. You can see we pulled back. However, once it fell below this low, the market collapsed. The final bulls gave up on the premise of a bull trend. Some bulls gave up here, others gave up here. Possibly minor higher low, possibly a 2-legged pullback, 1, 2. Bulls trying to buy here, but everyone agreed that if it fell below this higher low or this higher low, then the bull trend is no longer valid. The market's then either in a big trading range or in a bear trend. And you can see the give up bars, the very big sell-off, and that represents the final bulls deciding that their premise of a bull trend is no longer valid. In fact, their premise of a bull trend or possibly a deep pullback in a trading range is no longer valid once it fell below that low and that low. Very strong breakout, follow through. Chances are the market's going to fall for some measured move down. The market's always in short. Traders are selling for any reason, and they'll sell the first rally, betting that we'll get at least a small second leg down after a surprise breakout like that. A bear trend, we have lower lows. More importantly, we have lower highs. You can draw a trend line across the top of the channel. You can draw a line below as well. As long as the bear trend keeps getting strong breakouts to new lows, traders believe it's in a bear trend. If it rallies above one of the major lower highs, traders will conclude that the premise is no longer valid. It's no longer a bear trend. If it's not a bear trend, then it's either a trading range or a bull trend. Is this a major lower high? We have a breakout and we have a new low. However, the breakout is not particularly strong. Some traders would consider this to be relatively minor, and therefore, if the market goes above it or a little bit above it, they'll say that maybe we're still in a bull trend. This is more important. We tried to reverse up strongly. We got a double top bear flag. We have a persistent sell-off lasting about 30 bars. This is, I think, a more important lower high. A weak bear breakout, if it goes above this high, it's not necessarily clearly bullish. It's less bearish, but not necessarily clearly bullish. When I get a reversal up from a weak sell-off like this, especially when we're still in a bear channel, we're still below the bear trend line, the first reversal up is probably minor, which means either a bear flag or a bull leg in what will become a trading range. If the market is converting into a trading range, traders will switch how they're trading. They'll look to buy low, sell high, and scalp. They'll no longer hold short for swing trades. They'll take profits at new lows, betting that the breakouts will not fall very far. And they'll sell rallies, betting that the bulls will be unable to get a reversal. Bulls will buy at prior lows, betting that the bear breakouts will fail. And the market becomes a trading range because traders are buying low. Both bulls and bears buy low, and both bulls and bears sell rallies. Neither one holds on to positions long because they think the market will not go very far up or down. And the result is the market goes sideways. We're sideways here, a double bottom, a little bit of a wedge pullback, 1, 2, 3, and then a double bottom here. A surprise bar, a big bull trend bar, and a follow-through bar. We're probably always in long, and we'll probably get at least a small second leg up. 1, pullback, 2. If the market rallies above a major lower high like this, the bears will give up and the bulls will get very confident, and the result could be a bull trend. Double bottom with this low and any of these lows, a double bottom and a higher low after breaking above the bear trend line, so a double bottom, higher low, major trend reversal. The bars are small, we're in a tight trading range. No sign that the market's going to go very far soon. However, it's reasonable to start to buy, maybe above a bull bar like this. Lots of small bars, the market's going sideways, lots of reversals, bad follow through after bull bars and bear bars. The market thinks this is an appropriate price. Both bulls and bears are satisfied with this price. However, every trading range is followed by a breakout, and if there's a strong breakout with follow through, the bear trend will probably evolve into a trading range or possibly even a bull trend. If there's no strong breakout and follow through, you have to assume every breakout will fail. A bear breakout, bull attempted a breakout, and then bears, bulls, bears. We have a bull breakout and follow through, a pair of bull bars closing above the high of the past maybe 50 bars or so. Good for the bulls. It's not especially strong. The bars are not all that big relative to what we've had over here. And the follow through, instead of being a series of very big bull trend bars, is a series of small dojis. This is a weak rally, and probably this entire rally will end up as a bull leg in what will become a trading range. We're attempting to reverse up from a lower low, and then we sold off to a new low, sold off for maybe 15 bars, and we had a big bear bar. This is, I think, an important lower high. If the bears are going to continue to believe the market's in a bear trend, they do not want the market to rally above any major lower high, because then their premise of a bear trend is no longer valid, and they'll have to switch how they're trading. So instead of trading like a bear trend, they'll trade like a trading range or a bull trend. 10 or more bars to a new low, pretty good bear bar, pretty good bear breakout. We have lots of reversals in here. A higher low here, a lower high here, and even here we have a higher low here, a lower high here. Most of these reversals create minor lower highs and lower lows. You can see, even going down, going up, we're just not getting good follow through either way. This entire sell-off looks like it's a bear leg in what will become a trading range. This rally, the absence of consecutive big bull trend bars, probably a bull leg and a trading range, and that's true all the way here. The only clearly strong lower high, major lower high, is here, maybe here. Some computers will consider this major. Most computers will not consider these as particularly major. And if the market breaks above these lower highs, probably the breakout is not significant. It's probably not changing the market into a bull trend. There's another problem with this lower high that makes it really not all that important. It's not the top of the current bear leg. It's like this, a lower high after the top of the bear leg. This is not nearly as major as this, and the same is true of this. If you're looking for a major lower high, you want it to be the top of the current bear leg, not halfway down. And the same with this. We have a bear breakout, but does not go to a new low. Going above it does not convert the market into a bull trend. Even going above this does not convert it into a bull trend. It weakens the bear case, but probably the market's transitioning into a trading range. Even looking at this rally, bull bar doji, pair of bull bars tail, and then looking at the sell-off, bear bar doji, bear bar bull bar, a bear bar doji, bull bar, bear bar bull bar, all of this trading looks like the market's evolving into a trading range. Trading ranges resist changing into trends. Therefore, if the market breaks above these lower highs, even with a relatively strong breakout like this or like this, it's probably simply a bull leg in a trading range. The bear trend has evolved into a trading range. It has not turned into a bull trend by simply going above minor lower highs. Here, we closed above the top of the entire range. This, I think, is a major lower high. We got a new low. We're starting to form a series of higher highs, and now we have a breakout and a follow-through bar. This is potentially a gap for a measured move up. The trading range now is converting into a bull trend. Strong bull breakout above lower highs, but not the top of the current bear leg. These are minor lower highs, and that is not enough to make traders believe the market's now in a bull trend. It's probably a bull leg and a trading range. After the bull breakout, look at the bar that followed, the two bars that followed. They pretty much totally reversed the entire rally. And bad follow through after the breakout, that means that more trading range is likely and less likely the start of a bull trend. Strong bull breakout, bad follow through, probably bull leg in a trading range and more sideways. The same right here. Strong breakout above the top of the sell climax, but bad follow through, probably sideways. Here we have a breakout and a bull bar and another bull bar, also a close above the top of the past 40 or 50 bars. The tails on top make the rally less likely to be very strong. However, the breakout is good enough, so traders will expect at least a little bit more up, maybe a measured move up based upon the height of the trading range. Top of the range, we have a double top, and we have a neckline. Instead of falling below the neckline for a measured move down, we're breaking above the double top. Therefore, traders will look for a measured move up. And you can see what happened when the market got around the area of the measured move target. The bulls took profits and the bears probably started to sell, at least for a scalp. Trends do not go on forever. They eventually change. Trading ranges do not go on forever. They eventually break out. If you're in a trade and you're trading based upon the current price action, but the price action changes, you have to change how you're trading. Let's say you're a bull and you see a 4 consecutive bull bar breakout to a new high, breakout above a wedge top, 1, 2, 3. In general, if you break above a wedge top, 50-50 chance you'll rally for a measured move up, 50-50 chance the breakout will fail and reverse back down. But let's say you bought that close, the 4th consecutive bull bar, but it's also the strongest rally in the entire trend, certainly in the last 20 bars or so, and therefore 60% chance it's an exhaustion move and the market will trade down to the bottom of the buy climax down here. You have to be ready to exit if you bought that close, if you get bad follow through, and you did. This bear bar is terrible follow through for traders who bought that close. If you bought that close, your initial stop is right below the bottom of the breakout, the most recent major high or low. However, after you get 3 or 4 consecutive bear bars closing near their lows, your premise of a bull trend has to change. This looks more like a reversal and an exhaustive buy climax, and if so, 60% chance we're going to get down below the bottom of the buy climax. 4 consecutive bear bars closing on their lows makes a reversal more likely than a continued bull trend. Your premise of a bull trend has changed. Do you wait for the market to hit your stop? Of course not. You no longer believe it's a bull trend. You believe this is an exhaustion gap, this close to that high, and then once this bar closes, this low to this high, this to this high. The market is now probably having an exhaustive buy climax and a reversal down to the bottom of the buy climax. And then it decides whether to fall for a measured move down or go sideways, maybe resume up. Most bulls would exit below that bear bar closing on its low, betting that this is a higher high major trend reversal, bull trend, bear breakout, higher high, especially an exhaustion gap. The strongest bull move late in a bull trend probably is the end of the bull trend, especially if you have this kind of bar following the bull breakout. Aggressive bears will sell, betting that this is the end of the bull trend and that we'll get down to the bottom of the buy climax, and that the breakout above the wedge top will fail. Bears wanting a higher probability will wait until the market has 3 or 4 consecutive bear bars, and then they'll sell the close here or sell the close here and put a stop above here. Higher probability to wait for several consecutive bear bars. But your stop is further away. If you sell below this bar, you get filled here. If you sell the close here, your stop is still here, further away, but higher probability. Reasonable to short either way. Again, whenever you get the strongest bull move late in a bull trend, it's probably going to be an exhaustive move, and the market will probably get down to the bottom of the bull breakout before it goes for a measured move up. Also, whenever you have a wedge top, any place where there's a logical stop, the bears are sold here, their logical stop is above the high of this bar. Anytime the market hits a logical stop, 50-50 chance the market will continue up for a measured move, maybe based upon the height of this range. 50-50 chance the breakout above the stop location will fail and the market will reverse down. You can think of it as consecutive tops. We had a wedge top, failed, and now we have another top, an exhaustive bi-climax top. A triangle, you can simply call it a tight trading range. If you want, you can call it a triangle. 20 or more bars long in a bull trend often becomes the final bull flag. If there's a bull breakout, the market tries to come back to the middle of the triangle. We know that there's a 60% chance the market is going to come all the way down to the bottom of the bi-climax when you get that kind of a follow-through bar. Maybe a trading range, maybe a bear channel. In any case, we have a bear breakout closing far below this low, and then we have a follow-through bar as well. 2 legs down, measured move down, likely. Because of that, some bears will sell that close and put a stop above the top of the current bear leg. This is a very tight bear channel. It looks like a 7-bar bear microchannel, and that means that the bears are strong. They'll sell the first reversal up. The first reversal up will therefore be minor and lead to either a trading range or a bear flag. The bulls can argue a wedge, 3 pushes down, 1, 2, 3, parabolic wedge. They can also argue this doji is a pause from this breakout and the start of a second leg down. This breakout and follow through are strong enough so the market will probably have at least a second leg down, and it's possible that these 2 bear bars represent the end of that second leg down. Some bears will look at this and say, okay, we have 6 good bear bars, 8 bars in the bear channel. Chances are the first reversal up is minor, and therefore I'll place a limit order to sell at the high of the prior bar, and I would get filled here, betting that the reversal up is minor, and it will become a bear flag, or simply a bull leg in a trading range. The bears who did sell do not like this bull bar closing on its high and having a big bull body. Therefore, they're wondering if the parabolic wedge is taking control of the market. 3 reversals up, 1, 2, 3. This might have been the entire second leg down after this first leg down. Rally continuing. Now we have 4 bull bars, 3 with decent-sized bull bodies. Some bears will sell at a 50% pullback of the bear trend. Top of the bear trend, bottom of the bear trend, 50% pullback. 4 consecutive bull bars closing near their highs. Possibly we've already had the second leg down. However, very tight bear channel, the first reversal up, probably the best the bulls get is a trading range. Also, big down, surprisingly big up. Big down, big up creates big confusion. Big confusion is a hallmark of a trading range. Probably the market's going to go sideways. However, because of the big reversal up, the premise of a bear trend is probably no longer valid. Instead, the market probably is evolving into a trading range. After the 3 bull bars closing on their highs, a lot of the bears will exit, and then they'll wait, just in case this in fact is a reversal that will lead to a bull trend. 3 bull bars in a bear trend, bull bars closing on their highs. Most traders assume there'll be at least a small second leg up. Traders who are short will exit. They'll take the loss. If they sold here and sold more here, they'll just get out here, and they'll look to sell again in a few bars if the market starts to resume down. Aggressive bulls will say, well, we got 3 good-looking bull bars, 2 closing on their highs, both good-sized bodies. Probably the first reversal down will not get very far, and therefore I'll place a limit order to buy at the low of the prior bar, and I'll get filled right here. And these bulls will scale in lower as well, betting that the first reversal down will result in a minor bear resumption, a higher low, and at least a small second leg up. And this is what we got. We continued up. We had a pullback to around 50% and then a bigger second leg up. Some of the bears who sold this close kept their stop above this high. Sometimes when you have two reasonable stop locations, for example here, the top of the sell climax or the top of the bear trend, it's okay to use your stop above either one. A lot of traders will put it above the top of the sell climax. Whenever the market has a big reversal like this, big down, big up, it's probably in a trading range. When the market's in a trading range and there are two logical locations for a stop for the bears and the two stops are relatively close, it's usually better to use the higher stop because the market often goes above the lower one, but not above the higher one. So it goes above the lower one and reverses down. I talk more about this in the video on how to trade in trading ranges. Remember, you have some bears who sold here and put a stop above the top of the entire bear trend. Some bears sold here and they get out above this high, but they'll sell again on a reversal down. The scale-in bears who sold here, some would sell below a bear bar here, others would wait for the second leg up and then sell below a bear bar here or here. This is especially good because it went above one resistance level but not above the second. You have some bears selling here and selling more here, stop above the top of the entire bear leg. Many will place a limit order to get out at their original entry price, trying to get out break even on their first sell, even though the market retraced almost all of the bear trend. They get out break even on this sell. On this sell, they exit here as well, and they make a profit. And you can see when the market got to this original entry price, it bounced. That's a sign that some traders were buying, and some of those traders were bears buying back shorts. I call these scale-in bears. The bears sold here, they added to their position on the reversal down, they scaled in, they are scale-in bears. We have three strong pushes down, even below the bottom of this strong bull leg. And now we have an exceptionally strong reversal up. Traders will look to buy the close of this bar, and they'll buy any pullback. For example, above this bar, a high one buy, or even with a limit order below this bar, betting that there'll be a second leg up and the reversal down will become a bull flag and not a bear trend. They can buy the close, they can buy with a stop above the high of this small bull flag, a decent looking bull signal bar. The stop is either below the bottom of the buy climax or below the bottom of the entire bull trend. When you buy a close like this, there's always a possibility that the market could pull back very deeply all the way down to below the bottom of this buy climax. If it does, then a trading range is more likely than a bull trend. But if it's trading range, a bear leg will be followed by a bull leg, and the traders who buy here and put a stop here or here probably will be able to avoid a loss and usually are able to make a profit because after that sell-off, we'll have big up, big down, big confusion, trading range. The market probably will trade back up here to create a top to the trading range. We have a strong bull breakout, bad follow through here and again here. Possibly this is a bull leg in a trading range and there could be a very deep pullback. Now we have a wedge, three pushes up, 1, 2, 3, or 1, 2, 3. Even though 3 did not go above 2, it's still 3 pushes up. I call that a truncated wedge where the third push does not go above the second. Computers still treat it like a wedge and they'll look to sell a reversal down and bulls will get out on a reversal down. Different ways to draw the wedges. Different computers see them differently. Also 1, 2, 3. Like I said, even though it's a slightly lower high for the third push, it still functions as a wedge. It's 3 pushes up. Micro double top, a bear inside bar. Many bulls will exit there, betting that it's a failed breakout above a prior high. We're probably evolving into a trading range. We have a wedge sell-off. We have a wedge rally. It's reasonable to exit there, concluding that the premise of a strong bull trend is no longer valid. A trading range is more likely. And now we have 3 consecutive bear bars closing on or near their lows, decent-sized bodies. The bulls have a bull flag, they got a breakout, and now we have a bear breakout. Again, the premise of a bull trend is no longer valid. Probably the best the bulls get is a bull leg in what will become a trading range. And possibly it could be a reversal, bull trend into a bear trend. After 3 consecutive bear bars, the remaining bulls, many of them, will exit on the close of that bar. And bears will sell as well, betting that the market is reversing and that we'll get down to the bottom of the buy climax, and that the bull trend, in fact, is simply a bull leg in what will become a big trading range. A bull trend has a series of higher lows. If the market falls below a major higher low, then the premise of a bull trend is no longer valid. The market's probably in a trading range or a bear trend. Likewise, a bear trend has a series of lower highs. As long as pullbacks respect major lower highs and do not go above them, the premise of a bear trend is still good. The market is still in a bear trend. If it gets above a major lower high, the market probably has evolved into a trading range and possibly has reversed into a bull trend. Anytime you're taking a trade, you're taking it based upon a belief, a premise. For example, if you're buying in a bull trend, you believe the market's in a bull trend. Trends do not last forever. If your premise of a bull trend is no longer valid, do not continue to trade the market like a bull trend. Exit and then reevaluate what to do. The same is true for a bear trend. If your premise of a bear trend is no longer valid, exit and then look for your next trade and trade in a way that's appropriate for the current market condition. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 7 videos on protective stops. I want to talk a little bit about wide stops in this video. We have a bull trend here and a breakout of a bull flag here, possibly an exhaustive end of the move. We have a big bear bar closing on its low, but then we have a 2-bar reversal, down, up, and a good-looking bull signal bar. It's a high one buy. Chances are we'll go up at least a little bit higher after this strong bull breakout, despite this attempt to reverse. If you take this buy above the high of this bar, you get filled here. You could put your stop right below the bottom of the bar, but the 2 consecutive bear bars, that could lead to a second or third leg down. So 1 pullback, 2 pullback, 3. For example, a wedge bull flag, wedge higher low. If you're taking this buy, it's probably better to use a wider stop, either here or even better here. Why here instead of this? It's a buy climax. It could be an exhaustive end of the move, and its low is a magnet. However, if the market falls below the low of this bar, probably some buyers, if it falls below the low of the entire bull leg, probably the bull trend has ended. Some traders prefer to use a wide stop to have a higher probability of success. In general, a small stop means small risk, and it means a very good risk-reward ratio. A good risk-reward ratio always means low probability of success. You lose most of the time. Some traders want a high probability of success, and a good way to do that is increase your risk. Use a wider stop. Another way to do it is increase your reward. For example, go for a reward equal to 2 times your risk or more. The market's pulling back from the high. We got the second leg up, first leg pullback, second leg. It could get a third, fourth leg up, but we're starting to pull back here. 1 leg down, 2 legs down, 3 legs down. If you want, you can call it a wedge. You can call it a high 2, high 1, high 2. The bulls have a breakout above the top of this small channel, the wedge bull flag, but it immediately reversed. Once you have a big bear bar closing below the low of the wedge, followed by a second bear bar closing on its low, you're probably going to get a measured move down, a failed breakout below the bottom of the wedge. That would be the minimum objective. At this point, you have 6 consecutive bear bars, 4 closing on their lows. This is a give-up set of bars. The bulls are giving up, and the bears are selling aggressively. The odds are the result will be at least a measured move down. It's a sell the close market. A lot of traders will wait for the breakout bar and wait to see if there's one more bear bar closing near its low, and then they'll sell the close. If you're a bull and you bought here and you did not exit here, I would recommend exiting on the follow-through bar after the bear breakout, and don't wait for your stop to be hit. You have a wide stop, but the premise has changed. Instead of a bull trend, the market now is always in short. It's probably going to fall for a measured move down, which means it'll hit this and probably this stop as well. Not only should the bulls exit here, and this is a sign that they did exit, consecutive bear bars breaking below a wedge bull flag, bears will sell that close as well, and they'll sell low 1 and low 2 bear flags. For example, we rallied up here. Traders will sell below the low of this bar, and they'll get filled on the bottom of this bar. And now they have a low 2 short with a bear sell signal bar. They'll sell here as well. Their stop will be above the top of the bear reversal, this bear breakout. The market rallied. We have a strong leg up and a second leg up, possibly a trading range, possibly a second leg trap. It's also an expanding triangle, 1, 2, 3, 4, 5, with a good bear bar. Bears will sell on the reversal down below that low. You can also draw a channel here, and you could say the market's reversing down from the top of a channel. In this particular setup, a price action stop, you'd put it right above the top of this bear reversal bar. 2 legs up in a triangle, a good looking bear bar, top of a channel, expanding triangle. If the market goes above the high of this bar, it's probably better to exit because your premise of a triangle top is probably wrong. Reasonable to put a price action stop, a stop based upon the price action, above the top of a strong sell signal bar with a reasonably good sell setup. Most likely, the market will remain in a trading range, but you might get a swing down, and it should not get above the high of this bar. If it does get above the high of this bar and reverses down again, traders will stop themselves out and then sell again on the second reversal down. To allow for that possibility, some traders will sell below the low of this bar, and they'll get filled here, but they'll use a wider stop, maybe based upon a measured move based upon the height of this bar. Maybe they'll put their stop here, 2 times the height of the signal bar. Some traders like to use money stops, like a fixed number of ticks or a fixed number of pips from your entry price. Maybe 10 ticks, maybe 20 ticks from the entry price, maybe 10 pips, maybe 20 pips from the entry price. If this were a daily chart or a 60-minute chart, they would use many more pips. Let's say you sold below the low of this bear reversal bar, given expanding triangle, top of the channel, and you did not want to risk to above its high. Instead, you might want to risk to just above the midpoint, or you might want to risk exactly 10 ticks or 10 pips. Reasonable choice, but I think a better choice is a stop above the top of the sell signal bar, which is just a little bit higher. You might, in fact, want a stop above the high of this bar, and maybe you're a person who always uses a money stop, a multiple of some minimum, like 10 ticks or 10 pips, in which case 10 ticks or pips is not enough because it's not above the top of the bar, but 20 ticks or pips is enough. The market has a number of good bear bars, good selling pressure, and is trying to reverse down. If the market gets above the high of this bar, what's more likely? A strong breakout and a new bull trend, or a failed breakout and a reversal down? Probably a reversal down. They sold above the high of this bar, and it came back below the breakout point. They sold above the high of this bar, it came back below the breakout point. They sold at the high of this bar, probably is going to come back below the breakout point. If it gets above the high of this bar, what do you think is going to happen? Traders will sell it, and it will come back down far enough for the bears to make a scalp. And therefore, if the market goes above this bar, chances are there are sellers above. If it goes far above, the bulls will probably win. You'll probably get a measured move up. Some traders know that it could easily go above the high of this bar, but still reverse down again, and those traders allow for that by using a wider stop, either a money stop or a stop based upon the price action, a price action stop. A lot of traders don't worry about picking the exact top. When you pick the exact top, you have to be totally prepared to sell at the exact instant. And some traders are slow to decide, or they tend to do other things while they're working. They're not watching at the instant the market reverses down. They also don't want to worry too much about the market maybe going another leg or two higher. They're just getting confident that the market will go down soon. They'll sell, and they don't want to worry that the market may go a little bit above the top of their sell signal bar. They're confident that the market's going down, and therefore they want to use a wide stop. If this is not the top, they believe the top will come soon. Unless the market goes far against them and hits a very wide stop, they're confident that the market will get a reversal soon and they'll be able to make money. Whenever you are trying to get a higher probability of success, as I said, you pay for it with an increased risk. You have to use a wider stop. Also, you often will be willing to scale in higher, which additionally increases your risk. You need to keep the total risk on any trade to be no greater than on any other trade. And that means if you're using a wide stop, especially if you're willing to scale in, you have to reduce your position size so that if you get stopped out, you do not lose more than you do on any other trade. The market has been sideways for about 50 bars and now has an exceptional bear bar closing on its low, far below the low of the past 50 bars. And not only that, there's a follow-through bear bar. Probably this will lead to a measured move down. At a minimum, a 60% probability you'll get a measured move down from the open of the first bar of the breakout to the close of the final bar of the breakout. Here it's a 2-bar breakout. 60% chance it'll fall for a measured move equal to that distance before it gets above the top of the bear breakout. Traders will sell that close of the follow-through bar. Some will sell as the bear bar is forming because it's clearly bearish and falling quickly. They'll put their stop above the top of the bear leg, which is also above the top of the sell climax bar. And in this particular case, let's say it's 50 ticks if you're trading the E-mini. If it's a Forex chart, let's say it's 50 pips. For some traders, when they see a bar that is so much bigger than all the prior bars, they don't want to risk all the way to its high. They know that if the market pulls back to around 50%, a lot of bears will sell a 50% pullback. And therefore, they'll put their stop maybe 5 ticks or 5 pips above the midpoint of the sell-off. They entered here, the top is up here, this is the midpoint, so maybe they'll put their stop 5 or 10 ticks above the midpoint. They might also want to use a money stop, for example, 20 ticks or pips above the entry price. These are all reasonable stops. I think the best stop is above the top of the bear leg. And obviously, a wider stop means greater risk. Greater risk means worse risk reward, and that always is accompanied with higher probability. In general, whenever you use a wider stop, you're increasing the probability of making money. I think of the three, this is the most logical stop, but some traders do not have an account size that would allow them to use that stop, and they therefore will have to use some other stop, like just above the midpoint or maybe a fixed number of ticks or pips. 60% chance of a measured move down, 60% chance if you sell this close, it'll fall this distance before it goes that same distance up to the stop. You know where the entry price is, you know where the stop is, and therefore you can create a target equal to the distance to your stop. And there's a 60% chance that the market will get there whenever you see an exceptional breakout, good context, and a good follow-through bar. Some bears will place limit orders to take profits at 1 times risk. Whenever you take a high probability trade, the trader's equation is positive when you take a reward equal to 1 times initial risk. In fact, it's positive if you take a reward equal to 1 times actual risk. If you sold here, your actual risk is probably just somewhere up in here, certainly no greater than above this bar. And theoretically, you could take a profit here. That would be the minimum acceptable, a 60% chance of reaching that target before losing that many ticks. However, in general, when I'm trading a big breakout with follow through like this, I'm basing my target on initial risk, not actual risk. The minimum is based upon actual risk, but when you get a breakout like this, 60% chance you're going to get a measured move based upon initial risk. So you have much more potential profit. Again, the higher the probability, the worse the risk reward. Whenever the probability is high, which means 60% or more, as it is here, you can go for a smaller reward. For example, 1 times your initial risk. We have a reversal, possible final flag, trading range after a bull trend. We have a strong breakout and a strong reversal. We have a bear inside bar. Some traders will sell below the low of that bear bar, betting that the bull breakout will fail and that will get a swing down. That is a reasonable thing to do. Failed breakout above a tight trading range, and this tight trading range is probably the final bull flag in this bull trend. You can put your stop above the top of the sell signal bar. I would put it above the top of the bear trend, because sometimes it'll go a tick or two above the top of the sell signal bar, but not above the top of the bear trend. And the two stops are close together. I think you get higher probability if you use the stop at the top of the bear trend, which is always the case. Whenever you use a wider stop, you have a higher probability of making money. The market's in a bear trend, a bear breakout, good follow through bar, probably some kind of a measured move down, maybe based on the height of this double top. In any case, the bears have a double top bear flag here, probably at least one more leg down, 1 pullback 2 or 1 pullback 2. Traders are starting to look for some kind of a reversal up into possibly a trading range. Here we have 2 legs down, 1 pullback 2, a failed breakout below this low. The bulls made money buying at this low. This is probably the start of a trading range, and therefore if you get a bear breakout and a reversal up, especially with a very good buy signal bar like this, traders will buy above the high of that bull bar. It's reasonable to put your stop just below the low of that bar. It's a very good looking bar. 2 legs down, 1 pullback 2, possible final flag. The bear trend itself is not especially strong. We have a tail here, a reversal here, a reversal here. This looks like a bear leg in what will become a trading range. And now we're getting a failed breakout below a low after the bulls made money buying at this low. And you have a very good looking bull bar for the signal bar. It's reasonable to put your stop just below the low. If you get stopped out and the market reverses up again, you can buy again. Minimum goal, whenever you have a reasonable bottom, is 10 bars, 2 legs, sideways, 2 up. We have consecutive sell climaxes, a little bit here, and then these bars, and then here, a little here, a little here, a little here. That increases the chances that at some point the market will have 2 legs and 10 bars sideways to up as a minimum. And you get reasonably good buying pressure. A tail here, bull bars, reversal, reversal, and now a very good looking buy signal bar. The channel is tight. The first reversal up, probably minor, a bull leg in a trading range, but it could end up being major. In this particular case, the bulls got a swing up lasting 40 or more bars. You can call this a double bottom higher low major trend reversal. You have a bear trend, a bull breakout, a tight trading range, and this would be a major reversal. This is a minor reversal. This is a minor reversal. This is a minor reversal. However, sometimes a minor reversal leads to an opposite trend, a swing trade, even though the odds are more likely that it's going to go sideways and enter a trading range. A lot of traders like to use a default size for a money stop. For example, a reasonable number of ticks or pips from the entry price, regardless of the price action. Again, a lot of traders don't worry about picking the exact top or the exact bottom, but they're pretty good at knowing that a bottom or top is going to come pretty soon. To make sure that they don't get stopped out on a minor new low, here in a bear trend, they'll put a stop well below the signal bar. For example, some might use the size of an average trend bar for their stop. Other traders might use 10 to 20% of the average daily range, and they'll use a stop that far away from their entry price. It looks like we're entering a trading range. We have a bear trend, a lot of reversals, a lack of consecutive big bear trend bars. The trading range has replaced the bear trend. Traders are buying new lows. They bought below this low, below this low. In fact, they even bought below that low, and they'll certainly buy below this low. And now we're getting a reversal up. You can call it a spike and channel bear trend. Spike, pullback, second push, pullback, third push. I know it does not look like a channel, but it's basically a variation of a spike and channel trend. You could put your stop just below the low of this bear leg, or if you prefer to use a fixed number of ticks or pips, you might put your stop 10 or 20 pips or 10 or 20 ticks below the low of the bar, or about an average size of a bar, or about 10% of an average daily range. This would all be around the same general area. Your purpose is you're allowing for one more leg down, confident that when the market fell below here, they bought just a little bit below. When it fell below here, they bought just a little bit below. If it falls below here, they'll probably buy a little bit below. If it falls a lot below, then your premise is no longer valid. These traders will buy here, use the wider stop, instead of getting stopped out here and then having to re-enter on another reversal up. They would rather just buy what is reasonable, use a fairly wide stop, trusting that if it falls below this low, it will soon reverse up without hitting this stop. A lot of traders like to use a price action stop based upon a measured move. For example, we have a trading range. We have a double top, this high, that high. This is the neckline of this double top, and the bears are hoping that we'll fall for a measured move down if we break below the neckline of the double top. The bulls believe that it might fall to that measured move, but it probably will not fall much further. And therefore, if they buy here, they might put a stop just below this measured move target, betting that the bears who sold will take profits around the measured move target, and a trading range like this probably will not result in a strong bear trend. If the market does sell off, it probably will not fall much below this measured move target. And therefore, they'll put a stop just below that target, confident that if it falls down here, it will reverse up again. If they buy here, and if it does fall down here, maybe they can buy some more on a reversal up, confident that the breakout will fail and it will get back to this entry price. And then if it does, you can get out break even at this entry price. And if you bought on a reversal up, you'd make a profit on your second entry. If instead it does this, then you simply hold on to your position and ride the swing up. We have a sell climax bar here. If you want to use a measured move target to create a stop, you could argue that it's a sell climax. Maybe the market will fall for a measured move based upon the height of that bear breakout, which would be here, and then you could put your stop just below that low. The reason why traders like to use a wide stop is it gives them time to allow their premise to work. Most of the time when you're using a wide stop, you're going to exit before your stop is hit. But the stop gives the market time to work in your favor. As long as you believe your premise is still good, you can rely on your stop, trusting that you're right and that the market will go your way, but it may go a little bit against you before it does go your way. If it hits that wide stop, you will conclude that your idea is no longer valid, and therefore it's appropriate to get out of your trade. Take the loss. We have a bear trend, a head and shoulders bottom, left shoulder head, and a right shoulder. This is a reasonable buy. Yet we're breaking below the right shoulder. Bulls exit there, and you can see that's why we got this big bear bar. We have a good looking head and shoulders bottom, a wedge higher low, down, up, down, up, down, up, a good looking buy signal bar. A lot of these bulls who buy here will put their stop just below this low. And you can see this big bear trend bar is those bulls getting stopped out. When you get a bear breakout below a head and shoulders bottom, Usually better than a 50-50 chance you're going to get trend resumption down. Maybe a measured move down, maybe based upon the height of this double top, this high, neckline, measured move down. Maybe based upon this double top, this high, neckline, measured move down. However, now we're getting a failed bear breakout. The bears have a breakout, but where is their follow-through bear bar? Instead of a bear bar, we got a bull inside bar. It looks like the bear breakout below the head and shoulders bottom right shoulder is failing, and the bear breakout below the low is failing. And this, instead of being a failed head and shoulders bottom, might be a wedge bottom, 3 pushes down, 1, 2, 3. You can see as soon as it fell below this low, traders bought. Sometimes you take the initial buy, you get stopped out, you get a second entry buy, higher probability, and it can go a long way. If you want, you can call this a nested wedge. 3 pushes down, 1, 2, 3, and the third leg had 3 pushes down as well, 1 or 1, and then 2 and 3. And you have a decent buy signal bar. Some of the traders who bought this higher low believe that if it fell below this low or this low, 50-50 chance it'll fall for a measured move, 50-50 chance the bear breakout will fail and reverse up. I think that's reasonable. Those traders will use a measured move for their protective stop. So if they buy above this bar, they don't want to exit at the low of this bar, thinking that it's an attempt at a bottom. Maybe the market needs one more attempt at a bottom before you get a swing up. Traders with that mindset, and it's an okay thing to do, will use a wide stop, allowing for the market to fall below this bar and even below this low, betting that if it does fall below, it'll still reverse up as it did here and here. We fell below this low, they bought. Below this low, they bought. Below this low, they bought. Below this low, they'll probably buy. So if you buy here, you can use a wider stop. Likewise, if you buy here, you could use a wider stop as well. Maybe we'll get a small second leg down after this bear breakout, but probably not much more down. If your premise of a reversal is valid, it should not fall too far down. And therefore, if you buy above here, maybe use a stop based upon a measured move down. We have the right shoulder and then the top, the neckline. Chances are the market will not fall here, or you can use a measured move based upon the height of the entire trading range. Double top, neckline, measured move down here, trusting that we have a lot of trading range price action and any break below will reverse back up. So if you decided to use a measured move based upon the height of the right shoulder, that's the measured move, and you put your stop just below. In this video, I talked about wide stops. A lot of traders use wide stops because they do not want to worry about picking an exact top or bottom. When they use a wide stop, they have to trade small. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 7 videos on protective stops. There are many different ways to choose a protective stop. An important one is one based upon a measured move or other support and resistance. Whenever there's a small signal bar, if you put your stop just beyond that bar, your risk is small. However, whenever you have excellent risk reward, for example, when you have a very small risk, the probability of profit is very small as well. It's usually better to use at least a slightly bigger stop. Different ways to view this as a wedge: 1, 2, 3, or 1, 2, 3, or 1, 2, 3. Reasonable to take the sell. A lot of reversals, a lot of two-sided trading, and when above this high, they sold. When above this high, they sold. Above this high, they sold. Above this high, they sold. Above this high, well, they'll probably sell, especially given that there are multiple ways to draw a wedge. It's reasonable to take the short, selling below the low of this bar, and you get filled right here. A series of buy climaxes here, 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 and again here. Usually that results in a reversal at some point, And now that we have a nested wedge, this is a reasonable location to bet that the market will begin to reverse. Strong breakout, probably will get at least a second leg up. Well, this qualifies as the second leg up. Whenever I see a wedge, 1, 2, 3, I want to see the pullbacks drop below the breakout point. I want to see a stairs pattern. I do not want to see gaps staying open. If I see gaps staying open, the market's probably going to continue higher. But if the pullbacks drop below the breakout point, that's a stairs pattern. That means that the bull trend will probably soon be replaced either by a trading range or a bear trend. If you take the sell below this bar, you could put a stop just above its high. Or you could argue that the market went this high above this breakout point. Here's that same distance. It probably will not go further if it breaks out above this high. And therefore, you look at how high this is above that. You create a box here, you make the same box here, and you put a stop just above that. A measured move based upon the height of the last stair, betting that this stair will be no bigger than that stair and that the bull trend will weaken over time. Strong rally. We tried to reverse a second time, tried to reverse a third and fourth time, and the reversals are failing. Bulls will look to buy a reversal up. It's a wedge bull flag. Plus we have a gap here in this low, possibly a measured move up. Traders will buy above the high of the prior bar. We have a breakout and a pullback. This would be another buy above the high of that bar. You get in right there. If you want, you can draw it this way as a triangle. 3 pushes down, 1, pullback, 2, pullback, 3. Triangle bull flag. We have a big breakout. We're trying to reverse up repeatedly. This is a potential measuring gap, the gap between this low and that high, the breakout point. If the premise that this is a bull trend is valid, the market at this point, once you enter here or here, it should not close this gap until after it gets up to this high. Therefore, it's reasonable if you buy above this bar, get filled here, above this bar, get filled here, to put your stop below the bottom of the gap. Here's the bottom of the gap, and stop just a little bit below. Whenever there's a strong bull trend, bulls like to buy a 50% pullback. This is a strong bull trend, reasonably strong bull trend. And this is a 50% pullback. Some traders know bulls will buy here. If it falls much below there, bulls will conclude it's not a strong bull trend. It's either a trading range, maybe even a bear trend. A strong breakout here. Here's the 50% pullback. Let's say you bought at the absolute worst price right here. The bull trend is strong. Probably the worst the bears will get is a trading range instead of a bear trend after such a strong rally. And the same is true here. The reversal probably will be minor, either a bull flag or a trading range. In this case, it did reverse into a trading range. A trading range means that if it does fall even below 50%, it probably will not fall below the low before it gets back up to the high. Because of that, some traders will put their stop just below a 50% pullback. Here's the rally, here's a 50% pullback. Some traders will put their stop just below the low of the 50% pullback. Here, a 50% pullback, the bottom of the trend, the top of the trend. Even if you bought at this high tick, you could reasonably put your stop below a 50% pullback. Better to put it down below the bottom of the bull leg. But if you put it at the 50% pullback and you get stopped out here, you can always buy on a reversal back up, either above here, above this bull bar closing on its high, or above this bull bar closing on its high. If you get stopped out and the market again reverses in your direction, you can buy again. You can call this a triple bottom, a head and shoulders bottom, left shoulder, head, right shoulder. You can call it a wedge, even though this did not fall below that. In any case, the bears 3 times tried to get a swing down and they failed. And the market's reversing up. And it has a decent buy signal bar here. It's reasonable to buy above this bar, and you get filled on this bar. If you're lucky and we break above the top of the double top, the market will probably rally to a measured move up, which turns out is at the top of this bear leg. If you buy, you might want to use a wider stop, thinking that, well, if you bought here, it fell below that low. If you buy here, it fell below this low. Maybe if you buy here, maybe it'll get another small leg or 2 down. But it should not fall for a measured move down if your premise of a rally coming soon is valid. If it does fall below this low, then probably the market's in a continued bear trend, and your thought that it's going to reverse is wrong. And therefore, it's reasonable to put a stop down here, because if it falls below that measured move target, your belief is wrong, and you should be no longer holding a long trade. Some traders will use an extreme stop, the height of the bear leg, and put a stop down here, looking to scale in lower if it does fall down here and starts to reverse up. Is that a bad thing to do? No, most of the bears who do use a wide stop like this or like this are never going to let the stop be hit. If there's a strong bear breakout with good follow-through, they'll get out on the close of the follow-through bar well above their stop. This stop is a catastrophic stop. If you lose power, if an emergency happens and you have to leave, if there's a problem with your broker, a problem with your software, anything, the wide stop will contain your losses, but give you time to have the trade go in your direction. Here's a 5-minute chart, and here's the 60-minute version of this entire 5-minute chart. These bars are exactly these bars, the 60-minute chart, the 5-minute chart. We have a wedge top, 1, 2, 3. Also, you can call it a bigger wedge, 1, 2, 3. A decent sell signal bar. Reasonable to take that short, betting on a double top in a trading range. Again, different ways to draw the wedge top. Different computers see it differently. Another way to draw it, but reasonable to sell here, reasonable to sell there. Some traders who take this short are not confident that it's the final top, but they are confident that if it's not, the market will top out pretty soon. They sold above this bar and made money. They sold above here and went down, above here and went down, above here, it probably will go down again. And a lot of the bears who took this sell want to allow for the possibility that it might go above the high, but immediately reverse down. They'll use a measured move, for example, for their stop. We have a double bottom bull flag, a neckline, here's the measured move up, so they might put a stop just a little bit above that. Again, they're never going to let that stop be hit, or they'll rarely ever let it be hit. However, if it does hit that stop, they know their premise is wrong, and they should be out, and they should take the loss. They're using the wide stop because they're confident that the premise is right. If they do sell here and it goes above the high of this bar, they're confident that there'll be sellers there and the market will eventually go down. And they don't want to sell here and get stopped out and then miss the trade. This red box is exactly this red box. If you were looking at the 60-minute chart when you took this short, you would be shorting right here. You can think of a wide stop, like here, as an ordinary stop on the 60-minute chart. On the 60-minute chart, if you were to sell below the low of this bear bar, a reversal down, 3 pushes up, you'd be filled right here. And that would be here on the 5-minute chart. This price on the 60-minute chart, if you took that short on the 60-minute chart below this bear reversal, and then you looked at the 5-minute chart, this is where you'd be filled. If you took that short, you would put your stop above the top of the bear trend, just above this high. Had you looked at the 5-minute chart, your stop would have been here at the top of this sell-off. And that's reasonable. It's a tight bear channel. Probably the first reversal up, bears will sell it, bulls will sell it as well. The bulls who buy will be buying only for a scalp. The bulls who were long will use any rally to get out with a smaller loss. Therefore, the stop should not be hit on the first reversal up. I think it's important to realize that if you have a small signal bar and you put a stop just beyond it, your risk is small. But whenever you have small risk, you're probably going to lose money. You have a small probability of success, and therefore a very tight stop is rarely ever a good thing to use. Here we have a bull trend, and we have another breakout to new high. This is a reasonable high one buy. However, let's say the signal bar is only 3 pips tall or 3 ticks tall. If you put your stop just below it, then you're risking about 5 pips or 5 ticks. You buy 1 tick above, 1 pip above, your stop is 1 tick or 1 pip below, your risk is 5 ticks or 5 pips. And that's small, especially compared to the size of the leg before it. Whenever you have a very small stop, that means you have excellent risk reward, small risk, big reward. It also means that you have low probability. If you have a low probability of success, you have a high probability of losing money. It's rarely ever a good idea to put your stop below the bottom of a very small signal bar. Instead, it's better to look to the left, look for the most recent strong rally, and put your stop below the bottom of that most recent strong rally. If it's a bull trend, it should not fall here before going up far enough to make a profit. There are many different alternatives for a wider stop. The point is, if you have a very small signal bar, do not use the low of the bar for your stop, because the risk is too small. That automatically tells you that the probability of making money is low. In other words, you'll probably lose money. Some traders will use the appropriate stop. They'll buy here, trade small, and then when you get a second entry, they'll buy more here or above this bull bar. Using that wide stop allows them to buy more if they want to buy more. It also allows the market to go a little bit further against them. They can hold on to the position, and then the trade ultimately is profitable. We have a trading range and a breakout, possibly a failed breakout. Some traders will sell the reversal down below that bar, that inside bar. They'll sell on a stop below its low, and they'll get filled right here. Let's say the bar is 3 pips tall. Then if you sell 1 pip below, your stop is 1 pip above, your risk is 5 pips, very small. Why will you probably lose money? If your risk is small, your risk-reward ratio is excellent, and whenever you have an excellent risk-reward ratio, you have low probability of making money. That means that most of the time you'll get stopped out and you'll lose money. Whenever you have a very small sell signal bar like this, it's a mistake to put your stop just above the high of the bar. You need a wider stop to improve your probability. You could use a money stop like 10 or 20 pips above, or you could use a stop based upon a measured move. The key is to trade small, and you can always add on if the market goes your way. The market went above the high of the sell signal bar, and then it started to reverse down again, maybe a wedge, higher high, major trend reversal. Some bears who sold here, used the wide stop, did not get stopped out, might sell more here, betting on a second entry short, failed breakout above a trading range. That is a higher probability short than is this. Second entry trades are usually higher probability. Strong bull breakout. It's a high one bull flag. It's a small buy signal bar. Probably better not to put a stop just below its low, although it would not get hit here. Instead, put your stop below the bottom of the most recent strong bull breakout. A wider stop means higher probability of success. A wider stop is greater risk. Greater risk means worse risk reward. Bad risk reward means higher probability of success. Too small a stop, the risk is too small, the probability of winning is too small. This is a daily chart. If you don't want to trade small positions on the daily chart, one alternative is to use options to express your opinion. Let's say you look at the chart at this point and you say, wow, that's a pretty good bear breakout. Very tight channel, probably going lower. And you look at the chart and say, wow, this is a daily chart. My stop is up here 15 days higher. That's just too much to risk. Instead of selling here and putting your stop up there, an alternative is to buy puts or buy a put spread. I talk about this more in the videos on options trading. If this were a stock, traders would call that a stock replacement strategy. For example, let's say you're short the stock and now your stop is very far away and you want to stay short, you believe the market's going lower, but you do not want that much risk. An alternative is to buy back your short so that you're flat and then go ahead and replace your short position with either long puts or a put spread. So you buy puts or you buy a put spread. Your risk is contained and smaller, and you're still able to hold on for a swing down if the swing down continues. What about something more complicated? Some other complicated option strategy? Not worth it. 90% of the time, trading simply a call or a put or a call spread or a put spread is a very good choice. We got a pretty good bull trend here. And therefore, you can buy for any reason. You could buy below a bar, betting the reversal will fail. You can buy above a bar, a high 2 buy. We got a breakout of a high 2 bull flag, a pullback, a breakout of the pullback. And then here, another breakout of a small bull flag. It doesn't matter why you buy. Here, we have a pullback that did not fall below this high. We have the potential for a measured move up from down here or here to this gap up here. If you're trading, if you're buying for any reason in here, the important thing to do is use a reasonable stop. You don't want it to be too small because, as I said, small stop means small risk. Small risk means you'll probably lose money. It's a low probability of success. And should you use a stop all the way down here if you buy here? Well, that could be much bigger than what you're comfortable risking. That could be unreasonable as well. You're always making trade-offs among the variables in the trader's equation. When you have a strong breakout like this or like this, the probability is high that the market's going higher. Whenever the probability is high, you always are going to have a bad risk-reward ratio. That usually means that the stop is far away. If you buy here, the stop is far away, and you're buying late, and therefore there's less reward remaining in the trade. High probability, buying a strong breakout like this, usually means bad risk-reward. That's the trade-off. Whenever you're taking a trade, because it has high probability, you pay for that high probability with bad risk-reward. Let's say you bought anywhere in here. One choice would be putting a stop below the bottom of the gap, betting that the gap will remain open. Obviously, the best stop is here, but for some traders, that's too much to risk, and therefore they need a tighter stop. One choice is right below the high of the breakout bar, betting that maybe we'll get a measured move up. You could also put your stop below the low of this breakout bar, or even below the low of this bar. I would not put it below this bar. It's so close to the bottom of the bull trend. I would instead put it here instead of here. But these are other reasonable choices. You could put your stop all the way down at the bottom of the bull trend down here or here. However, after 50 or 60 bars rallying, most traders would not use a stop that wide. They would use a tighter stop. Beginners often make the mistake of pretending that the risk they're exposing themselves to is really not as risky as they think. For example, let's say you buy a high 1 bull flag or a high 2 bull flag here. And you put your stop below the bottom of the bull trend. That is an appropriate location for the stop. If you're a beginner, you take that trade and you put your stop down here knowing it's the right place for the stop. Most beginners will panic and say, oh my gosh, I never thought it would get down here. I really did not intend to risk that much. They knew it was the right place for the stop, but they never were willing to hold onto their positions and rely on that stop. Whenever you're entering late in a trend, far above the most reasonable stop, your risk is great, and you have to trade small because you have to remain within your comfort zone, and you have to make sure that you are not risking any more on this trade than you would on any other trade. There's always a possibility that before we get a second leg up, we'll get a very deep pullback, and instead of this being the start of a bull trend, it might be a bull leg and what would end up being a trading range. If you buy up here for any reason, the correct stop is down here. If it falls below this low, your premise of a bull trend is probably not valid. However, instead of a bull trend, it could be a trading range and fall very far down, not hit your stop. And if that's true and it is a trading range, it'll probably come back up to your original entry price. Had you bought here and you bought more, maybe above a bull bar here, you could hold on for the market to come back to your entry price, get out break even on your first entry, and with a profit on your lower entry. The point is, whenever you take a trade and you see the obvious stop, you rely on that stop. If you cannot risk that much, do not take the trade. Even though the market pulled back very deeply, I think most traders would see it as still always in long. We had a pair of bear bars here, but possibly a wedge bull flag, a bear channel bull flag. For the rest of it, it never had consecutive big bear trend bars, and therefore it's probably still a bull flag. It's probably a bear leg in a trading range and not the start of a bear trend. If it's a trading range and it sells off, it probably will rally again and get back up to the top of the range. Many traders who bought here, if they see 3 bear bars closing below their midpoints or on their lows, will just exit, and that's reasonable. And then they can buy again on a reversal up. It's okay to hold on, betting that the market will not fall below the bottom of the bull trend, and you can add on lower. A lot of bulls will exit, and when the bears see 3 consecutive bear bars closing on or near their lows, they'll sell. Here's a high one buy. 3 bars down, a pullback. 3 bear bars, probably sellers above. So traders will sell this close, and they'll sell at the high of this bar, betting that it's a bad buy signal, and therefore probably sellers above, and at least a small second leg down. We have a spike down, a breakout, and then 3 pushes down. 1, 2, 3, or 4. It's a spike and channel, wedge, bottom. Most importantly, it's a higher low. It never clearly became always in short. If you relied on your stop and managed your trade correctly, you could buy again on the reversal up above this bull bar or this bull bar or this bull bar, get filled here, and the market will come back to your original entry price. You get out break even on your first entry and with a profit on your lower entry. Sometimes when you have a wide stop, it's going to get hit. Even if the stop makes really good sense, it's still going to get hit. You have to trade small enough so that if the stop does get hit, you do not lose any more on that trade than you do on any other trade. For example, we have a bear trend and a low 1 bear flag, maybe a low 2 bear flag. This is a breakout, potential gap, and measured move up. It's not a terrible short. It's an okay short. This certainly is an okay short. If you want, you can call it a low 1 or a low 2. A micro double top, you can call it a low 2 selling below that bar. You get filled here. And let's say you put a stop above the top of this sell climax or above the top of the entire bear trend. Either one is reasonable. And then we got this huge bull breakout. Whether you put your stop above the top of the final bear sell climax or the entire bear trend, your stop got hit. And that's going to happen. In general, a stop is going to get hit on about 40% of trades until you become experienced. Traders who did put their stop above the top of the bear trend got stopped out over here. But if you trade small enough so that if you get stopped out, you do not lose any more on this trade than you do on any other trade. It's basically erasing your last positive winning trade and not your last 10 positive winning trades. I talked about how measured move targets can be useful in determining where a reasonable stop should be, and that's true for other support and resistance as well. Also, sometimes you'll have a reasonable setup and the signal bar is very small. It's usually a mistake to put the stop just beyond the signal bar. Small signal bars fail too often. The market goes beyond the signal bar and then again resumes in your intended direction. It's usually better to use at least a slightly wider stop. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 7 videos on protective stops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 7th of 7 videos on protective stops. I want to talk a little bit about break-even stops. Traders use them regularly, but there's no mathematical basis for them. I also want to talk about the importance of breakout tests. The market goes your way and then comes back to the original entry price. And finally, I want to talk about stops for scalpers. Most traders should not be scalping, but everyone ends up scalping at least some of the time. The very best scalpers tend to use wide stops and scale in. But again, most traders should not be scalping. When a trader uses a break-even stop, what they mean is the market goes your way and then you move the stop back to around the entry price. It does not have to be exactly the entry price. Maybe you make a small amount, lose a small amount, but around the entry price. If the stop gets hit, you only lose the brokerage cost and maybe a little slippage. So a small loss, sometimes a small win. Sometimes you'll have the stop a little bit better than break even. And sometimes a small win and you end up a little bit better than break even. If you have a small loss or a small win, traders refer to that as a break even trade. Let's say a trader sold here, betting on a possible trading range and a double top, and we have a small bear body here. The trade eventually goes his way. Some traders will hope for a swing trade and use the stop above the top of the bear leg. Other traders, after it goes their way, will decide that, well, it's gone far enough. I really don't want to come back to my entry price. If it does, I'll just get out break even. So they'll lower their stop from up here down to just below the low of the sell signal bar. As I said, when a trader uses the term break even or break even stop, they don't mean necessarily exactly break even. Although in general, when a person talks about a break even stop, they're talking about putting the stop exactly to their entry price. In this particular case, let's say you used an exact break-even stop. You sold below the low of this bar. You got filled right here. The market went your way a little bit, and you were not happy with the follow-through, and you decided, well, I'll get out if it gets back to my entry price. So you put a stop at your entry price, and the market comes back, hits that price, and you get filled here. And all you lose is the commission, or maybe a bid-ask spread, or maybe a little bit of slippage. I think one of the interesting things about a break-even stop is that there is no mathematical basis for a break-even stop. The main reason for using a break-even stop is that you're confused or you're upset, and whenever that's the case, it's okay to get out for any reason, and sometimes the easiest decision is simply to put your stop at break-even. Whenever you believe your objective is no longer reasonable, it's good to get out, and if the market is very close to your entry price, sometimes traders will quickly put their stop right at break even. The reason why there's no mathematical basis to a break even stop is that your stop choice is not related to your entry price. It's related to the price action. It doesn't matter where you sell, above this bar, below this bar, below this bar, above this bar, below that bar, selling this close, selling down here. The stop is the same. It's above the top of the bear leg. To use a break even stop, there's no mathematical basis to it. It's simply an emotional thing. Sometimes you're just too upset, the market's moving fast, you have to do something, you want to get out. A lot of traders just quickly move their stop to break even. And that is okay. We're people, we have feelings, we're not machines, and we take time to make decisions. If you feel like your premise is wrong, you have to get out. As I said, it's always best to select a stop based upon the price action, but a break-even stop does make sense when you're scalping, and in one other special instance, a second breakout test. A lot of times, traders will let the market come back to their entry price as long as the trend resumes, but they do not want the market to come back to their entry price a second time. If it does, it usually means the trade is no longer valid. In that particular instance, it then makes sense to exit with a break-even stop. Scalpers, a lot of times, will use break-even stops. They'll take a trade, the market goes to their profit-taking limit order price or very close to it. They do not want the market to come back to their entry price, so they'll quickly move their stop to break even. When the market gets very close to their target, then the risk is to their entry price or the original stop. It may be 4 or 5 times greater than the remaining reward. At that point, you need an extremely high probability to remain in the trade. And if you get a reversal or start to get a reversal, then the probability is no longer high, and therefore the premise is no longer valid. You have very little reward left. You have a lot of risk relative to the reward. You need a high probability, but the market is coming back against you, and therefore you do not have high probability. A lot of traders need to get out, and when the market's starting to come back, it's probably very close to the original entry price. Many traders just quickly move their stop to break even, or maybe a tick better than break even, maybe a tick worse than break even. For Forex traders, maybe a pip or two better or worse than break even. Let's say a trader sells below this bar. They can have a double top neckline hoping for a break below and a measured move down. The rally is not strong. It's probably a bull leg in a trading range. So they have a double top at the top of a trading range. Original stop, probably above the top of this bar because it's also above the double top. And you're taking a short, believing that you have a double top, which you do. And let's say you had a profit-taking limit order right here. You made some calculation that this was a good location to exit with a scalp, and the market came very, very close to your scalp, and it did not fill your order. And then it started to reverse up. What do? Some traders will exit on the reversal up or on the second reversal up. Other traders will give it time just in case we have one more push down. And a lot of those traders do not want the market to come back to their entry price. They do not want to take a loss after coming so close to a profit. They'll simply move their stop to break even, and then they'll get filled right here. If a bear is very quick, he can move his stop down to above the high of this bar or above the high of this bar and end up with a little bit of a profit. A smaller profit than what he intended to get, but better than having it come back to his break-even stop. For example, the bear might try to exit above this bar, a small double bottom, a second reversal up from below this bar. Maybe he'll buy above the high of a bull bar closing on its high and get filled here and end up with a small scalp, smaller than he intended. That's still basically a break-even trade. It's a small profit, smaller than what the scalper intended. Most traders would call that a break-even trade. Different ways to draw this. Some traders would see this as a wedge, 3 pushes down, 1, 2, 3. I know this is a small push down, but it led to a big reversal up. It's a significant bottom. And then we're also testing this prior low. You can also call it a smaller wedge here. We have a double bottom and a bear breakout. So you have 3 pushes down, 1, 2, 3. Anytime you have a double bottom and a breakout that reverses up, it's a type of wedge. And here we have a micro double bottom, down, up, down, up. It's a reasonable buy, a good looking buy signal bar. It's a reasonable swing. The channel is too tight probably for a scalp. Maybe you can get a scalp. Some traders would take this for a swing trade, betting that maybe we'll retrace 50% of the sell-off. The sell-off lacks consecutive big bear bars. It's probably a bear leg in a trading range, and we are reversing up near a potential bottom to the range. Maybe we'll get a couple legs up. Let's say we have an IOI here. He buys above the bull bar, gets filled here, and puts his stop below the low. There's a breakout, and then there's a pullback. To me, this is a breakout test. Even though it fell below the high of the signal bar, that means it fell below the entry price as well. This pullback is simply a test of the resolve of the bulls. It's testing the breakout above the high of this bar. If you're swing trading, most bulls will allow the market to come back below their entry price. They'll rely on their stop. However, once the bull trend resumes, we have another breakout, 3 consecutive bull bars. A lot of traders do not want the market to come back to their entry price a second time. If it does, they conclude the bull trend is not valid. If this pullback falls below that entry price or the signal bar high a second time, especially if it falls below this low, traders will assume that instead of a bull trend, the market is probably going to go sideways in a trading range or possibly even reverse down. We have a double top neckline. We could fall for a measured move down. This would be the break-even stop, just a little bit above the high of this bar. It's hard to see. You could say it's at the high of the bar. The market rallied the way the bulls expected. It tested the resolve of the bulls. It tested below the entry price, and it's testing again. A lot of traders will get out if it hits that entry price a second time. They assume that if the bulls are good, they'll buy heavily right above their original entry price, trying to prevent the market from coming down, hoping to get a second leg up. Therefore, some traders, if the market goes their way, falls below their entry price, and then goes their way a second time, they'll get out, break even, just above the high of that bar. The second breakout reversed up from above the top of the buy signal bar, and it formed higher low major trend reversal, a double bottom, good bull bar here, and then a good bull bar here, and it led to a swing up. Bulls will buy above the high of this doji inside bar, and especially above the high of this good-looking bull bar. This is, I would call, a perfect breakout test. It missed the break-even stop by about 1 tick or 1 pip. The bulls defended their break-even stops. They prevented the break-even stops from being hit. That is a sign of strong bulls, and it increases the chances that they'll get a swing up. So once this starts to go up, bulls are confident we'll go higher, and that's why we got this big bull bar and a follow-through bar. And the bears also gave up. This is bears giving up. They tried to get below that break-even stop, believing that if they could, the bulls would give up. Instead, it's the bears who gave up. When there's a bull trend, bulls like to put their stops below the bottom of the most recent strong leg up, below the bottom of the most recent major higher low. Here we have a biclimax, a breakout. Some bulls will put their stop here, but this is a magnet. I usually use a wider stop down at the bottom of the bull leg. It's reasonable to put your stop here. The market often comes down and tests it. Very often, in fact, it goes a tick or so below it, and then it can reverse up. Whenever you get this strong bull breakout, strong reversal, you get big up, big down, big confusion. Usually the market goes sideways and then decides whether it's going to resume up or reverse down. When you have a perfect test of the bottom of the bull breakout like this, and then a reversal up, you're probably going to get a test back up to the high. Big up, big down, big confusion, trading range likely. Bull leg in a trading range, bear leg in a trading range, probably going to be followed by another bull leg and another test of the top of the range. Bulls are trying to defend their stop. They know the bears want to break below the bottom of the final biclimax and then hope for a measured move down. The bulls hope for a test of that low, basically a double bottom. I know this is not the bottom of a sell-off like this, bottom of a sell-off, bottom of a sell-off, but it's the bottom of a bull breakout, and therefore it's a type of bottom. And if the market comes down there and reverses up again, you have a double bottom. Two different types of bottoms, the bottom of a bull breakout and the bottom of a sell-off, but it's still a type of a double bottom. Bulls place limit orders to buy just above that low and at that low, and they also place stop orders to buy the reversal up. And the same is true here. The market's coming back down to that critical price. The bulls will buy with limit orders at and just above that price, and they'll buy on a reversal up. Their concern is if it falls below, their premise of a bull trend is no longer valid. The market will either remain in a trading range, maybe falling a little bit lower, or it'll reverse into a bear trend. We have a bull trend, a bear breakout, lower high major trend reversal. The bears have a reasonable sell pattern, and the bulls are trying to prevent the market from falling below this higher low. It's also a neckline of a double top. Some bears will sell if it falls below here. You'll have the lower high major trend reversal bears happy that we're breaking below the neckline, and you'll have the double top bears selling, betting that will fall for a measured move down. If you're buying right above this low or on the reversal up, your risk is small. And that usually means the probability is small as well, and you'll get stopped out a lot. However, if you do get stopped out and there's a reversal up from below this bar, the bulls will assume that we're at the bottom of a trading range, and therefore it's reasonable to buy again if they get stopped out. Strong breakout. A lot of bulls will buy around the bottom of this breakout because the bulls bought strongly here and we rallied strongly. If we come down to that price level again, they'll look to buy again, near to the price or as the market reverses up from it. Here we have a small double bottom, testing the bottom of the buy climax. Bulls will buy. Clearly disappointed by this. And the bulls who put their stop just below this low get stopped out here. But that's okay. Bad follow through on the bear breakout. Bulls will buy a reversal up, betting that instead of a bear trend, this is a bear leg in a trading range. This is a reasonable location for the bottom of the range. There was strong buying here before. Maybe bulls will buy again if the market reverses up from that bear breakout. And therefore bulls will buy on a stop above the high of this bar. They'll get filled here. Again, another breakout, bad follow through. Bulls will buy on a stop above the high of this bar, and they'll get filled right here. As long as the premise is valid, bulls will keep buying on the reversals up. Their premise at this point is that we're in a trading range and they're buying a failed breakout below the bottom of the range. When they were buying here, their premise was that we were in a bull trend. When they bought here, they were hoping for a bull trend. But once we fell below here, I think the bulls changed and they started trading it like a trading range. Look to buy reversals up from below, looking for at least a scalp. The bears will do the opposite. When the market goes above a high, they'll assume it's a trading range now as well. Since we fell below key support, they'll look to sell at and above prior highs, betting that the breakout will fail and that will come back down. Some bulls will say, okay, it's a bull breakout, and yes, we fell below the low of the bull breakout, but we're still above the bottom of the bull trend. And instead of putting a stop just below here, they'll use a wider stop below this part of the bull leg or below the bottom of the bull trend. That's because bulls know that when you get a strong breakout, a lot of times the market comes down to the bottom of the breakout, and sometimes a little bit below, especially when the breakout is late in a bull trend. There's an increased risk that it's an exhaustion gap. For example, the gap below this low and the breakout point here probably will close at some point. It tried to close here, it did close here, and very often, I would say half the time, if you start to reverse down, you're going to get to the bottom of the bull breakout and usually a little bit below. And bulls do not want to get stopped out. They can, and they can buy again on the reversal up. But a lot of bulls instead will look at this and say, it's not really a bear trend. It looks more like a bear leg in a trading range. Bear breakout, bad follow through, a second reversal up, bear breakout, bad follow through, bear breakout, bad follow through. And therefore, they rely on a wide stop and they'll buy on reversals up and scalp out. They don't want to keep getting stopped out, like buy here, stopped out, buy again here. they'll buy here and leave their stop down here, and then maybe get out here on the reversal down, basically a break-even trade. But they're hoping instead that the market went up higher and they could make a scalp, but sometimes it does not. We have a double bottom, a neckline, a strong breakout, and a perfect breakout test of the breakout point. We got a pullback from the breakout, and this is a potential measuring gap. The market's trying to resume up. Perfect breakout test of this high, so maybe we get a measured move up from either of these lows to here and then up there. We have a second breakout test, and it did not hit the breakout point. It's slightly above this high, and that's bullish. We have a decent bull bar here. The bulls defended their break-even stop, and that's a sign of strong bulls. This is a double bottom bull flag. Bull trend, a pullback to a double bottom bull flag, a decent buy bar. The problem is all of the small sideways bars, all the small dojis. This looks like it's more of a tight trading range than a bull flag, but it is a reasonable bull flag, and the bulls have a reasonable chance that the market will accelerate upward. And then trend resumption up, maybe for a measured move based upon the height of the gap between this high and this low. The second test is, I think, a really good test, perfect test. It missed the entry price. Had you bought on a stop above this high, you would have been filled a little bit above that line. This pullback hit the line. It would have triggered a break-even stop. And this pullback missed the entry price. Had you bought on a stop above this bar, you would have been filled just a little bit above this line, maybe on that close. And this high is above that close. So this is an absolutely perfect breakout test. Perfect in the sense that it got to within a tick or a pip of your entry price, but it did not hit your entry price. So it did not hit your break-even stop. That's a bullish thing. Yet the reversal up was weak. Instead of a strong bull trend, it looks like a bull leg in a trading range. A lot of traders will exit if it comes back down to their entry price again. Here it fell below this bar. Most traders would get out either below this bar or below this bar. The bulls had a pretty good double bottom bull flag after a bull trend, and they don't want it to come back down a third time, and they'll get out on a stop and get filled here, right below the low of the double bottom. The bears see this as a double top. We have a bull trend, a bear breakout, and a tight trading range. Whenever you have a double top and a tight trading range like this, and the tight trading range lasts 20 or more bars, especially if you get a decent sell signal bar, the bears have a 40% chance of a swing down, and that's what they got. The market fell for about a measured move down based upon the height of this double top. Double top, there's the top of it, here's the neckline. Neckline is actually right here, but this is obviously a key price, so you could argue it's the bottom of a trading range. The bears will look for about a measured move down to take profits, and you can see they took profits here, other bears took profits here. When you're scalping, everything is important. Every little mistake can cost you money, and the stop that you use is very important. Very few traders can make a living as scalpers, and the reason is you need to take the best trades, and it's usually better if you're willing to trade fairly large, and most traders cannot do that. If you're only going for a small profit per contract, per trade, you need to have a large position if you're planning on making a living doing that. One of the fundamental problems with scalping is on most of your trades, your stop has to be further than your profit-taking limit order. Your risk is usually bigger than your reward. And that means you have to win 70, 80, or 90% of the time. There are traders who can do that, but most cannot. And you should assume that you are like most good traders and you cannot do it, or if you can do it, it's not fun to do it, and therefore it's not realistic to assume you'll be able to do that for a living year after year. Let's say a trader sold here. We have a breakout above this high, first entry, second entry. You can call it a wedge, 1, 2, 3, parabolic wedge, a decent sell signal bar. But then we get this, we got a reversal up. So now we have a double bottom and a bull bar. The trader sold below this bear bar and he's buying above this bull bar. And then maybe he's selling here or selling there. He's not making any money. Stop entries in a tight trading range, a losing proposition. You should never do that, even if you're a scalper. Once you start to see a series of 3, 4, 5 small bars in a tight trading range with prominent tails, you should not be entering with stops. And most traders should not trade whatsoever. He sells here and maybe uses a tight stop and gets out above here. So he's losing money. He sells here, gets out above here. He buys here, he gets out, maybe below here. He sells here, he gets out above here. He sells here, he gets stopped out there. He buys here above a bull flag and he gets stopped out either below there or below here. You can see the problem. If you're scalping for a small profit and you're using a tight stop, you can easily lose a lot of money. Here we have a series of 5 scalps. All of them were losers using stop entries. As I said, whenever the market's in a tight trading range, you should not be trading. And anyone who is trading with limit orders. Using stop orders in a tight trading range is a horrible strategy. Most swing traders take occasional scalps, but you should really be focusing on swing trading. That allows you to use a reasonable stop, and you only have to be right 40% of the time because you're going for a swing, which means a reward that is at least twice as big as your risk, and that offsets the low probability. It's a profitable approach to trading. Really good scalpers can do something to increase their probability. What they do is they can use a swing stop and scale in. But as I said, most traders are not comfortable doing that. It's not fun. You have to be enjoying your job, and therefore most traders should not be thinking about scalping. It's stressful, and very few people have the personality that allows them to scalp every day, year after year. I talk about scaling in the videos on scaling in. Here we have a strong breakout above a bear channel. We have a series of 3 bull bars closing on their highs. It's reasonable to buy the close. This is a buy the close bull trend. And you know where the stop has to be. Below the bottom of the bull breakout, either below this bar or below that bar. A swing trader almost always has to use a wide stop. Sometimes he'll have a great signal bar and he can use a stop just beyond the signal bar. But more often than not, a swing trader is using a relatively wide stop. The trader can buy here, and then at the end of the session, the market's on a tight trading range, you have a bear bar, it's reasonable to exit below that bear bar, get filled here, and you made a swing profit. A lot of scalpers use wide stops, like a swing stop. For example, we have a high 2 bull flag, we have a bull trend, a high 1, and then we got a second entry here, a high 2. Ultimately, it ended up as a wedge, 3 pushes down, 1, pull back, 2, pull back, 3. This low is below that low. If you bought above this bar and you put your stop here, you lost money over here. One of the problems with scalping, especially using a stop entry in a relatively tight trading range. What some scalpers will do is use a wide stop, either below the bottom of the bull breakout or, better, below the bottom of the entire bull leg. They're not planning on having these stops be hit. They'll get out before these stops are hit. But those are catastrophic stops that protect you against some kind of catastrophe. Like if something happens in your house and you have to leave your computer for a period of time, or your electricity goes out, or your broker has problems, or problems with the exchange. You want to make sure that there's some stop that protects you against some big move against you, a low probability move, a black swan type of event. Some of these scalpers, relying on these wide stops, are looking to buy more. Here, now we have a wedge, we have a micro double bottom, and 3 reversals up, 1, 2, 3, 3 legs down, 1, 2, 3. A decent buy bar here, and a micro double bottom. Reasonable to buy more here. We have a breakout and a pullback, reasonable to buy more here. The scalper is not going to buy all of these buys, especially since these are right around that price, but sometimes the scalper who buys here might buy more here or here. As the market went up, his actual risk, if he bought here, was to just below the low of this bar. The scalper does not know that his actual risk is here when he takes the trade. He knows it when the market starts to go his way. He had to risk a little bit more than from his entry price to below this low to not have been stopped out. Once the market goes his way, he then knows this is his actual risk. And this is 1 times his actual risk. He's scalping, so he's going to go for a reward that is at least as big as his minimum scalp. And he also wants it to be at least as big as his actual risk. This is a reasonable location to take profits. I talk more about this in the videos on actual risk. We have a strong bull breakout, a buy the close type of rally. It's reasonable to buy that close or this close as well. Again, stop choices below the bottom of the breakout. I usually put the stop below the bottom of the bull trend because the bottom of the breakout is a magnet and the market often comes there or a little bit below, yet then resumes up. Sometimes it breaks below and falls for a measured move down, but most of the time if it breaks below, it either goes sideways or up. Let's say a trader bought here looking to scalp and this did not quite reach his target and he's disappointed by the tail here and the reversal here. He can either exit below the low of this bar and get out around break even, or he can use a swing stop either below here or down here and look to buy more if the market reverses up. He'll assume it's a bull flag and that will get a second leg up. He might buy more with a limit order at a 50% pullback of this bull breakout and he'd get filled there, or he might buy more above a bull bar and get filled above this bull bar right here, or above this bar and get filled right here. He might be so disappointed by the size of the sell-off that he's giving up on the intention of making much of a profit. He'll get out break even on his original entry and then with a tiny profit on his second entry. In general, if a trader is scalping and looking to scale in, his second entry should be at least the size of a scalp lower than his first, so that when the market comes back to his first entry, he can make a scalper's profit on his second entry. I talked about break-even stops, putting a stop to around your entry price. There's never a good mathematical basis for using them. However, sometimes emotionally it makes sense. If you're trying to get out because you think your trade is no longer valid and the market is very close to your entry price, a lot of traders will quickly move their stop to their entry price, a break-even stop. If they make a little or lose a little on that stop, they still call it a break-even stop. I also talked about breakout tests. The market goes your way and comes back to your entry price. Traders will usually allow the market to come back to their entry price once, but if the trend resumes in your direction, they do not want it to come back to your entry price a second time, because if it does, they'll question the premise of a trend. I then talked about stops for scalpers, and one of the difficulties for scalpers is that the reward usually is less than the risk, and a lot of very good profitable scalpers use wider stops like a swing stop, and they're willing to scale in to increase their probability, accepting that it increases their risk as well. One of the big problems that beginners have when they scalp is they're using stops that are too tight, or they're entering with stops in tight trading ranges, which is a horrible strategy. They're going to lose money. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 7th of 7 videos on protective stops.